Well, thanks so much for having me. I hope you can all see the slides now. So this is joint work with Dan Kovitz from the Federal Reserve Board and Karen Pence, and the usual disclaimer applies. These are our views and not those of the Federal Reserve. For full disclosure, I should add that all three authors have worked on at least one iteration of TALF, so just so you know where this is all coming from. So why do we care? We think in this paper about designing a liquidity facility with non-banks, in part because during the financial crisis in 2008 and then also during the COVID-19 crisis, we have seen that a lot of non-banks came under stress, and the non-bank sector has increased, not just in the US, but all over the world. And that leaves central banks sometimes with limited options if they only grant access to banks, which is traditionally the way things work. Moreover, since the financial crisis, there are programs that have now allowed non-banks to come to the central bank. For instance, the overnight reverse repo facility comes to mind. And going forward, one can think more broadly about like how should we think about conducting monetary policy with non-bank counterparties. During the crisis, facilities often target banks or financial markets. And again, TALF being like the big exception from the rule that target a market with a large set of counterparties. So our contribution here is that we have new microdata. So we are going to use the borrowers and all the collateral that was used for TALF loans. And we're going to show you that the funding conditions and the investment parameters of the non-banks matter for participation. So over the lifetime of the TALF loan, we will see different types of institutions coming in and out, depending on how funding evolved and what the investment parameters of the non-banks are. There's a very strong trade-off between participation. So usually we like to have a lot of participation, making it easy to participate. But if we do this, then we may encourage too much risk-taking, and we will look at this trade-off and how it was solved in this particular case and what we can learn more broadly about this. And going from there, we can also talk about how the incentives of different types of investors are better aligned with the different goals of the central bank. So just as a motivation, you may have seen these charts already, right? So asset-backed security spreads flew out in 2008. They went up to almost 1,200 basis points for commercial mortgage-backed securities, but also for auto ABS, they flew out. And for CLOs, we had the rerun in 2002. You've already seen stark differences between 2008 and 2002, most notably in 2002, the spreads, as you can see here, fall with the announcement of TALF, and I will share my thoughts what has been going on in there towards the end of the talk. More generally, asset-backed securities fund a large share of credit, especially in the personal loan space, credit card loans, auto loans up to 45%. And with spreads blowing out, issuance of this asset-backed securities came to a halt. So on the right-hand side, you can see in the dashed lines, the spreads, and in the solid lines, the issuances. And you can see as soon as the crisis hit, spreads blow out, issuances tank. And as such, credit availability to consumers, but also businesses, suffers immensely. And so these programs were designed to address this credit supply to businesses and households. And to do this, we can think about direct versus indirect interventions. By indirect, I mean intermediate interventions. And there's a trade-off between speed and market discipline. Specifically, if you think about an intermediary model like TALF, where you hand out loans, the market participants still need to assess the risk of the security that they use as collateral. It also provides a natural exit strategy because as soon as the loan matures, by itself, there is an exit, right? And you can decide to not originate new loans with the program. And so the the program shuts down almost by itself and it runs off the balance sheet. Of course, the downside is it takes time to design and you have less experience and you run a little bit more risk. It takes more time. If you have a direct purchase program, you just go out and you buy stuff. Here, it's somewhat more complicated. We are going to use now TALF as an ideal case study because it has this broad range of non-bank investors. In the ABS space, more generally speaking, the traditional investors were pension funds, insurance companies, mutual funds, real estate investment trusts, and banks. And then with the TALF program, new investors emerged, specifically hedge funds, fixed life funds, meaning mostly asset managers. And then a new type of fund popped up that was solely designed to invest into the TALF program. We are going to donate them as TALF only funds. You can think of it as a private fund that has as investment parameters that you can only invest in TALF eligible assets and you should get TALF loans for them. So the upshot here is the Fed innovated with the program, allowing counterparties to come to the Federal Reserve, and the markets do exactly what they usually do when there's an innovation. They innovate themselves and came up with these new type of investors. And what we're going to do here is we're going to look at the incentives and constraints of these investors and how that shaped their take-up in TALF. So here is TALF take-up during the financial crisis, TALF 1.0, and you can see over time, there was a lot of take-up in the beginning, especially in the ABS space, and then it subsided with the straps subsiding as well. Commercial mortgage-backed securities, the take-up was substantial. But I just wanted to point you to the beige portions here and also here. These are these TALF-only funds. These are these funds that were solely created to invest in TALF, and you can already see that they are actually very important. In TALF 2.0, you see considerably less take up because the spreads had already come down. But again, here the main borrower are these TALF only funds. So they are the main player in this program. When we think about how non-bank investors interact with the Federal Reserve and how the incentives of the non-bank investors interact with the Federal Reserve goals, we first have to define what the goals are. So we settled on 4 goals for the program. The first is we want to stabilize markets quickly. We want to have an exit strategy once market conditions normalize. We need to protect the government from losses. So this goal is mandatory under the 13.3, right? You should not incur losses. And last, the liquidity provision by this program should go through to a broad range of securities. So TALF gives you term loan to buy securities. It gives you an interest rate that is slightly higher than normal market conditions, but lower than stressed conditions. You borrowers have to oppose the haircut, so they have some skin in the game. That protects the government from losses, and it had to be high quality collateral, meaning it had to be AAA rated. So why is anybody coming to TALF? Well, the interest rate is more attractive than the market interest rate in stress times. There was term financing when term financing was otherwise not available. You may recall that in the financial crisis, you basically could only borrow overnight. You don't have margin calls. There's collateral, and that's it. It doesn't, like the haircut does not move with market prices. The loans were non-recourse, so if market prices dropped sharply, the TALF borrowers could just give the Fed the collateral, take the loss on the haircut, and say, now you deal with it. And there was no prepayment penalty, which of course was in part designed so that people would exit the program as early as possible or as they want to. The last step was there was a review process to ensure that collateral brought to the Federal Reserve was of sufficient quality, despite the fact that they were already AAA rated, especially in the CMBS space. We know that the rating may have been problematic. For ABS, there was a review of the new issuer. ABS, and if the Fed said we don't take this ABS, then the issuer had the problem that it probably couldn't issue that particular ABS at that time. For commercial mortgage-backed security is somewhat different because here we bought legacy CMBS, and here the New York Fed conducted a stress test and figured out whether the AAA rating was really a AAA rating. Okay, so what are the constraints here? There was high leverage in hedge funds and REITs, so they had little access to funding. Similarly, insurance companies, hedge funds, and REITs had these funding pressures more generally, either from redemptions, REITs lost their bank credit or repo facilities. Then mutual funds had regulatory constraints. There's only that much they can invest in. In fact, they also needed to get a waiver from the SEC to be allowed to invest in TALF, and then REITs, of course, can only invest in CMBS. The TALF-only funds had very strict investment parameters, and that will be salient a little later. If the New York Fed rejected a CMBS QSIP, TALF-only funds, in part, could not hold this CMBS and had to sell it potentially at a loss because they were required to get TALF funding for it according to their own investment plan. Okay, so how do we stabilize the markets quickly? Who's helping us? So the early entrants were those that had flexible investment parameters. So that means hedge funds, pension funds, insurance companies. We also had healthy, wealthy individual showing up early, and some asset managers. Then starting with the third subscription, we got the TALF-only funds coming in TALF 1.0. And then late entrants, in part because the SEC needed to grant mutual funds relief, mutual funds came in. But if you look about like how often certain types came, again, the striking thing is if you look over here, which is the share of hedge funds and TALF-only funds that came in 7 or more subscription, see 45% of these TALF-only funds showed up for at least 7 subscription, and 20% of the hedge funds. So they are also the ones that participate over and over again, whereas REITs and insurance companies, for instance, they didn't come that often. So again, the story here is there's these opportunistic investors that help to stabilize the market quickly. So those you want to get into the program. So exit. Again, you could either sit out the term loan or you can prepay. So who exits early? It's those that are motivated by capital gains, meaning hedge funds. Then there's these that hold on a little longer, and they have a trade-off between capital gains and managers' compensation. Those will include TALF-only funds. And then the buy and hold investors, such as pension funds. It's just a business model, right? They get term financing and they're just told this forever. And this is also what you can see in this chart. Pension insurance holding the longest, and the hedge funds and the private investors leaving early. Protecting the government from losses, again, here was the collateral review that then hamstringed somewhat the take up in the CMBS program. We had 1,350 CMBS that were eligible, but very few were actually brought to the Fed. A total less than 300 different QSIPs actually came to the Fed during the program, despite the fact that these spreads were fairly high. The problem here was the stress test of the Fed. And as you can see, there was something to the stress test. Those QSIPs that were rejected, they were much more likely to get downgraded later. They had longer weighted average life, which is one measure of riskiness, and they had somewhat more delinquent loans. And it was particularly stunning in October. You see in September 2009, there was no rejection. And then comes the so-called October surprise, where you get a couple of rejection, which is the bar. And then the solid line shows you the borrowers. So you see the number of borrowers sharply declining right after this surprise. And you see the dashed line, which indicates the share of previously accepted QSIPs shooting up, meaning instead of bringing us new QSIPs providing liquidity to more bonds, suddenly you bring things where you know that you are going to get money. And there's this nice market quote that basically says like this rejection was a random number generator and we couldn't figure it out. you can see that basically all investors, especially those with shaky funding, pulled back. The ones that pulled back most and then only brought us stuff that was previously accepted were these self-only funds that could not deal with rejection simply because the investment parameters were written this way. Then the question is like, who takes more risk? Late in the program, REITs and hedge funds regained access to funding and they started to take more risk. REITs weren't rejected in 2009 and then got a bunch of rejection in 2010. Coincidentally, this is also when they suddenly have funding from repo facilities and the like again. Moreover, the spreads had fallen for CMBS, but they were still high. So you still could make quite a bit of money, but apparently that was enough. So we got the riskier loans over time. So if we run a simple regression, we find that rejection was costly. The spreads go up around the rejection. They are first concentrated in the very first subscription, suggesting that there was a huge liquidity effect. So rejected CUSIPs had a much higher liquidity premium. But I also want to point out that the effect in the last subscription was still sizable with 18 basis points, meaning that towards the end, there was more risk taking again. And this is something to keep in mind, that when people know it's the last period, they behave accordingly. So I'm close to out of time, so let me run through this. So we want to have a lot of securities. Again, in the CMBS market, there's more than 1,300 securities, but not all came. But we had a broad range in terms of weighted average life. We had a broad range in terms of yield. And you can also see that those that had the most stable funding, meaning fixed life and health only funds, they took the most risk in terms of weighted average life. We also have regressions for that in the paper. And over time, everybody took more risk. So this is what this paper shows you. It shows you the weighted average life by subscription over time by type of borrowers. And you can see that towards the end, all of this is trending upward, meaning everybody is going to take more risk that in the securities they bring to the Federal Reserve's program. So again, it's important to have some checks on the risk in these type of programs. Otherwise, there's a chance that the central bank ends up with very risky stuff that it doesn't want to hold. So let me briefly talk about TALF 0.0 take-up, which was really low than TALF 1.0. First of all, there were less disruptions. The Fed intervened much earlier, and because TALF 1.0 was seen as quite successful, TALF 2.0 was already credible. So spreads in TALF 1.0 only declined when TALF actually opened and people figured out that TALF worked. In TALF 2.0, the announcement was sufficient. So what do we learn here? We learn that when the Fed started to promise liquidity in the near future for a market and it's credible, you already get it priced in, the spreads immediately decline. In fact, it declines so much. So here you see it in the picture, the horizontal line is the TALF loan rate. And you see by the time TALF opens, spreads on auto ABS are well below the TALF loan rate. Even on CMBS, they're close to the TALF loan rate, and only for the CLOs where you don't buy the legacy stuff anyway, they are still elevated. So the point here is that TALF was not an attractive proposition by the time it opened because participants have already arbitraged away the opportunity ex ante. Okay, so this also tells us a little bit about the mismatch between market conditions in the crisis and the way people try to invest in TALF. They love these TALF funds for some reason, but they're very static vehicles. They're inflexible, and yet they still make money out of this in this time. Okay, so what are the final takeaways here? First of all, the nimble investors in the crisis are existing vehicles with flexible investment parameters, hedge funds, for instance, but they also have fragile funding. Markets respond with their own innovation to central bank innovation, in this time the CALF-only funds. Investors who are chasing capital gains, such as hedge funds, will repay much faster than the income-focused investors, such as insurance companies and pension funds. And then lastly, there's this trade-off between having a protected balance sheet of the central bank and providing broad liquidity. You need this collateral review to avoid losses, but that will hamstring take up. And I will stop right here, and thank you for your time.
Thank you very much, Ralf. And the discussant is Jean-David Sigaux.
All right. All right. Do you see my slides?
Perfect.
Yeah. Okay. Thank you for the opportunity to discuss this interesting paper. I'm with the ECB, so the usual disclaimer applies. Let me give you a selective summary of the paper. The main research question of the paper is the following. Did non-banks act in a way that allowed the TALF program to achieve its goals? What are the main findings? To me, there are two main findings. The first one is that duration and pricing are heterogeneous across investor types, or at least duration and collateral. For example, if you take insurance companies, they kept the loan for 600 days, whereas pension funds kept the loan for half, 300 days. There's also heterogeneity, so in the collateral. So for example, fixed life partnership, they brought collateral of higher yields, so 2 basis points higher yield than other investor types. The second main finding is that loan rejection increases spreads by roughly 9 basis points over a 5-day window. And the effect is broadly decreasing over time. So how to reconcile the research question and these main findings? Well, we have to look at the TALF goals first to understand. One of the goals of TALF was to have a quick wind down. And it turns out that some non-banks held the loans for a long time. Those are the insurance companies we talked about. And this is not very compatible with the goal of a quick wind down. The second is the goal of broad market stabilization and all the segments of the market, including the risky securities, where there some non-banks really invested and brought as collateral risky securities. And this is positive, and this helped the Fed to broadly stabilize the market. And the third goal was to limit taxpayer losses. And it turns out that the Fed implemented a system whereby they could reject some requests for a loan, and this worked. It created a TALF eligibility premium, and therefore these non-banks acted in a way that is compatible with the goal, with some decreasing effect over time. So what is the main answer to the research question, did non-banks act in a way that allowed the program to achieve its goals? Well, for some goals, yes, and other less. Let me take a step back first and talk about the big picture. And then in the next slide, I'll talk about how the paper enters this big picture. So the big picture question to me is, should monetary policy cater to non-banks counterparties? And let me venture an answer to this question. And the answer would be mostly yes, because non-banks play a growing role in the economy. They may grant loans directly without bank intervention. They may have different needs than banks. However, it's mostly yes, but there are challenges for the central banks. First, the central bank does not know non-banks as well as banks. Second, non-banks are sometimes less regulated than banks. So if you combine 1 and 2, it makes it harder to predict, to control the behaviors of non-banks. And third, there is a large heterogeneity among non-banks. So how can you cater to this diverse crowd? Now, how does the paper enter this big picture? Well, it enters the big picture through these challenges. The paper gives us valuable information about these challenges. The first challenge was the central bank does not know non-banks as well as banks. Well, this paper hints at the fact that the central bank had the opportunity to learn this non-bank behavior by doing sort of a test run, the TALF 1.0. Of course, at the time, this was not a test run, but by the time we are getting to TALF 2.0, we may consider the first iteration as a test run. The second challenge was non-banks are sometimes less regulated than banks, and it's harder to predict and to control their behaviors. And this paper reviews behaviors that indeed are a bit against the Fed goals and that have gone against the program's objectives. And third, there's a large third challenge is there is a large heterogeneity among non-banks. So how can we cater to all this crowd? And more generally, this paper does document these heterogeneous behaviors. So in the remaining time that I have, and this is my next slide, I'm going to talk about the next steps for the paper. First, my main point would be to more clearly define the focus of the paper. For the moment, in the paper, there are 3 themes that are currently present. One is a sort of comparison between TALF 2.0 and TALF 1.0. It's interesting, but I would not advise the authors to make it the main focus of the paper. It would imply some tricky econometrics, and I'm not sure the authors will be able to convince the reader of a good identification strategy. The second theme present in the paper is what is the optimal design to successfully cater to all types of non-banks? That is very interesting because you may think, okay, there are 10 different types of non-banks, so I'm going to make sure that the program would be adapted to those 10 different types of non-banks. But this would be costly to design. It would be complex, and therefore there's a trade-off between complexity and addressing the whole universe of non-banks. It's an interesting. It would be an interesting focus, but it would require a model. Not sure the authors want to go down that road. And the third theme currently present is more the extent in which non-banks heterogeneity or non-banks heterogeneous behavior may pose some threats to monetary policy. This is currently the main theme of the paper, and I would advise the authors to make it the main focus of the paper, and maybe turn down the first 2 themes. I've highlighted two expressions, and so my next recommendations relate to these expressions. So monetary policy, I would recommend the authors to connect non-banks behaviors to Fed's key mandates, employment, price stabilization, in order to always have in mind the big picture of the Fed's role. For example, the paper shows that investors with stable funding, they held TALF loans for too long. And this slowed down the TALF wind down. But one could go one step further, and one might argue that it creates a too accommodative monetary policy, and therefore can challenge the Fed's mandate of price stabilization. This is this kind of reasoning that would enrich the paper. And third is the heterogeneity. So the paper currently does a good job to document the heterogeneity. Maybe the authors could go one notch further and document this heterogeneity more systematically. For example, document heterogeneity in the impact of loan rejection, which I believe was done in the previous version of the paper that I had the pleasure to read, but is no longer there. Okay, so I think it's time for me to conclude. This is a great paper. I think there's a couple of steps that the authors could take to improve the paper, and I look forward to the next version. Thank you.
Thank you very much. Ralf, I can give you a very brief response, and then let's invite comments and suggestions from the others.
Yeah, thank you so much, David. This was a great discussion. This is very, very helpful. Let me just jump in on the very last point about the heterogeneity in rejection by type and say, the reason we took it out is that by different borrower type, we just have very few rejections, and it's, you know, the inference is shaky, let's call it this way. So we decided to take this out, but the point is well taken about heterogeneity. So thank you again. And if you could send me the slides, I would appreciate it.
All right, we have questions from Sebastian and then from Quentin. Please, Sebastian.
Yeah, thanks. Yeah, Ralf, very interesting paper. So I was wondering whether you guys have thought about, and maybe I missed it in the presentation, sort of another interpretation of this heterogeneity of the investors is sort of getting to the two objectives that the central bank could have. One is stabilize market functioning. The other is sort of more monetary policy, stimulate the economy. It seems that if you impact, it seems very reasonable to me that the first impact that affects hedge funds is really because spreads were blown up because, say, a plumbing issue, you know, high risk aversion or something like that. And that was really a market functioning thing. Whereas the guys that came out later may have been doing another objective of sort of just, you know, providing credit and so on and so forth. So I don't know whether it could make sense to try to tease these out, perhaps not stated goals, but really sort of effective way of how it has an impact on the market. Thanks.
Thanks, Sebastian. That is a very interesting point. I mean, in some sense, because the program provides term financing to all type of different investors, right? It does address some market functioning issue, especially in the beginning of the program. That's right. And then over time, and I mean, it does that in a space that goes to credit provision. So to me, they go together in this particular program, but there's a point to be made more generally about monetary policy, how we want to think about this, and we can make that more explicit. So thank you.
Quentin?
Yes, thank you. So I thought there was a very interesting result, which is still a bit puzzling for me, which was that the pension funds seems to be getting out much later or actually holding to maturity. So I was wondering if this means that they are not exercising an in the money prepayment option. Is that basically what's happening? And if that's the case, I'm wondering why would that be the case? Do you have some insight on this point?
Yeah, I mean, in some sense, pension funds are I mean, this is a program that pays you leveraged returns, right? And that's not always what pension funds are doing. Like the question is, what's your next investment alternative when you're a pension fund, right? And given that they typically have a hold to maturity model, it seems plausible to me that they would just hold on to it because, you know, they're making a nice spread. And unless they can deploy the capital otherwise, why would they prepay? With hedge funds and other investors, the way manager compensation is structured, you want to make capital gains, you want to pay yourself. That's not true for the pension funds. So that is, I think, why the pension funds just hold on much longer, is because it's part of the business model. Same for insurers, by the way. They have a chance to make leverage returns that they otherwise don't. It's my interpretation of it.
Okay, that's interesting. Thank you.
Any more comments or questions, suggestions? If not, we'll move to the second paper, and it is do non-banks need access to the lender of last resort? Evidence from mutual fund runs, and it is presented by Marie Hoerova. Please go ahead.
Hi, everybody. I will try to share my slides. It takes a moment. Let me already thank the organizers for putting the paper on the program. We're very happy to be on the program. It's been a great conference. Somehow it's not coming up, my presentation, so a little bit strange. Let me, for 1 second, launch it again. Sorry about that. Okay. Now it's there. Excellent.
So Maria, I see it clearly, but maybe you would like to do full screen? Or?
Yes, in fact, I'm glad you see it well, but I don't see it myself. So let me see, I don't know whether it's taking some time for it to come up. Okay. Have never seen this before, and I don't see my own slides. Let me try again. Share. Okay, now I see them. Excellent. Okay, now you should see them, and I hope. Is that okay?
I see them very clearly.
Perfect, and you hear me as well. Excellent. So this is the paper about non-banks, mutual funds in particular, and it asks whether they should have access to the lender of last resort. And this is joint work with my ECB colleagues, Johannes Breckenfelder and Nicholas Grimm. I should also say that the views we express here are solely our own. We've heard time and time again in this conference that non-banks are becoming increasingly important. In the euro area, their assets doubled over the last decade, and they also became a significant source of funding for non-financial corporations. As their importance grew, so did concerns that the buildup of risks in non-banks can adversely affect financial stability and monetary policy transmission. And I think it's fair to say that in March 2020, some of these concerns materialized, whereby we saw an unprecedented liquidity crisis in the mutual fund sector. And as mutual funds face the liquidity crisis, of course, the question had to come up, do non-banks need access to the lender of last resort? Things that were discussed, for example, is whether funds need access to central bank liquidity facilities, or whether their shares should be eligible for central bank asset purchases. And so with this paper, we will try to speak to some of these questions. Let me start by showing you the extent of the liquidity troubles in the mutual fund sector. So here are sort of the runs on the euro area mutual funds that we want to document with this graph. This graph gives you aggregate net fund flows in percent between January and June of 2020. And what you see, so these are net flows, so inflows minus outflows. So what you see in March are very large negative net flows, meaning there are large outflows from the investment funds. And the outflows were as high as minus 0.5% of total net assets on a daily basis at the peak of the crisis. This was not specific to the euro area. Exceptionally large outflows were also documented for US bond mutual funds. And the issue was that as funds faced runs, they were trying to fire sell assets to serve redemptions, and that put strains on broader financial markets. So there is a couple of papers that talk about that, and Kairong has a very nice paper on this issue. So one way to get liquidity for a fund when it faces a run is to sell the assets it holds. Another way is to pledge the securities it holds as collateral in the repo market to obtain cash. What we document is that funds also faced a liquidity dry up in the repo market. So this is the chart that tries to illustrate that. It shows you new bank lending to mutual funds in billions of euros between February and April of 2020. And again, you see this very large decline in lending. In fact, lending went down by 50% between February and March, from about 30 billion a day at the beginning of February to as little as 15 billion a day by the end of March of 2020. So if funds try to get cash in the repo market, they also had more troubles getting that over that period. So what are we going to do in this paper? We are going to use this March 2020 episode as a laboratory to assess the impact of two central bank interventions and how they fared in terms of helping this liquidity crisis in the mutual fund sector. We're going to first look at central bank asset purchases and what would be the mechanism by which central bank asset purchases might help. Well, they may attenuate the fire sale dynamics in the asset markets and support market prices of assets held by funds. The second interventions we are going to look at is the central bank liquidity provision to banks. And the mechanisms there would be that banks who have access to the lender of last resort can come to the central bank, borrow liquidity, and channel some of it to funds through the repo markets. And so we will see whether this indeed played out in March 2020. We're going to use several data sets. In particular, we're going to lean on detailed mutual fund level data from the LIPA database. And we are also going to use a number of confidential ECB data, in particular on bank borrowing from the ECB. And we're going to match that borrowing with banks lending to mutual funds in the repo market. How do we relate to the extant literature? Well, first strand of literature we relate to is the literature on mutual funds, which is very large literature. The way we add to this literature, we think, is we highlight this additional fragility factor, which is a dry up in the repo funding that funds faced in March 2020. And secondly, we analyze central bank interventions, both asset purchases and liquidity provision to banks, and whether those helped mutual funds facing a large liquidity crisis. Second strand of literature we relate to is the literature on the effectiveness of central bank interventions. And again, lots of papers there looking in particular on the transmission of central bank policies through banks, on financial market impact, on the impact of new facilities. Our paper is going to be about effectiveness of interventions for non-banks that have no lender of last resort access. And lastly, there is a literature on money market functioning, malfunctioning in crisis times. And here we contribute by looking at bank repo lending to mutual funds in a liquidity crisis. So let me give you a bit of an idea of what we do when it comes to the first question, which is what was the impact of central bank asset purchases in March 2020 on mutual fund liquidity crisis. We're going to look at the impact of purchases on fund performance and fund flows. And we're going to zoom in on the new purchase program that the ECB announced. It was called the Pandemic Emergency Purchase Program, or the PEP for short. It was announced on March 18th, 2020, in the evening after markets closed. And it started being implemented as of March 26th. So the actual purchases under this program started on March 26, 2020. We're going to focus on a set of bond mutual funds that satisfy two criteria. First, they invest in investment-grade securities. Second, they hold a non-zero share of euro area securities in their portfolio. The reason we are looking at this particular set of funds is that first, we want to look at the set of funds that's relatively homogeneous. So we're going to look at funds that invest in investment-grade securities. We want them to be relatively homogeneous ex ante and then see ex post with the intervention whether we see any difference. We also want them to be reasonably affected potentially by what the ECB does. So we want them to have some non-zero euro area exposure in their portfolio. And then what we are going to do is extremely straightforward. We are going to compare funds with higher shares of assets that are eligible for the PEP program, ex ante. We're going to take their holdings as of January 2020. And we're going to compare them with funds with lower shares of PEP eligible holdings. Now, you might wonder, what is this difference in eligibility driven by? This is a relatively homogeneous set of funds. I told you they invest in investment grade securities. Well, the difference is related to, for example, to holdings of securities issued by US issuers or those securities that are issued by banks. Both types of assets are not eligible for ECB purchases. So what do we find in terms of PEP impact on fund performance? And we do a different analysis. I'm going to show you coefficients in a second, but I think this graph really tells the story of what we find. So let me take you through it. The graph gives you the fund market value change in percent between January and June of 2020. We normalize the performance to 0 in Jan 2020, and then we trace it over time for two groups of funds, the ones that have more eligible holdings and the ones that have lower holdings of PEP eligible assets. These are two groups of funds that we look at. And what you see is that their performance was remarkably similar, not only before the onset of the crisis, but also as these large withdrawals began in March, all the way until mid-March, the performance is extremely similar between these two groups of funds. But when PEP is announced on March 18, the performance of the group that has more PEP eligible assets improves immediately on announcement and starts going up, whereas the performance of the group that has less eligible assets still continues going down and only recovers gradually. The two lines converge later on. This is, in fact, exactly what we find in our diff and diff regression. So what we find is that after PEP announcement, this performance gap between higher and lower eligible funds was 3.7% in the announcement week. So this is this gap here. In the first implementation week of the PEP, the performance gap is still statistically significant at 2.7%, with the funds that have high eligible holdings performing better. And in the second implementation week, it's still 2.1% performance gap. Afterwards, the gap becomes insignificant. Now, it seems that PEP improved performance of funds that have higher PEP eligible holdings. Now, this is good news in a sense that we know from the prior literature that bad performance can trigger outflows. And so what we do next is to ask whether PEP also helped with outflows. And here are the results. This is sort of excerpts from our diff and diff regression. And what is interesting is to look at the sort of second line here, where we interact the week of PEP announcement and this eligibility dummy. These are the funds that have relatively more PEP eligible assets. And what we see, this is the differential between high and low PEP eligibility group, is that funds with more eligible assets had higher net flows, so they had less outflows compared to the other group of funds. This is whether or not we use controls. And in fact, if you sort of look as the benchmark at the outflows in the low eligibility group, then compared to that, net flows of the higher PEP eligibility funds improved by 63% relative to the other funds after PEP announcement. So there was a large increase in the net flows for funds that have more PEP eligible assets compared to the other group. In fact, what we find is by the end of March, runs on mutual funds pretty much stopped in the euro area and their flows largely stabilized. So this is sort of the key results we have for the PEP program. It improved fund performance and it improved the net flows of funds that had more PEP eligible assets ex ante as of January 2020. Let me now give you a gist of what we do in terms of the analysis of central bank liquidity provision to banks. And we're going to look at the impact of central bank liquidity provision on bank repo lending to mutual funds. We're going to look at new long-term refinancing operations for banks that were announced on March 12, 2020 by the ECB. They were called bridge LTROs, long-term refinancing operations. They were conducted weekly, and they all matured on June 24th, 2020. This is when another big pre-planned liquidity providing operation was due to settle. We are going to focus on the relationships that a fund had with banks prior to the crisis. So we're going to look at our transaction level data for the repo market transactions between banks and funds. We're going to look at bank lending to funds, and we are going to zoom in on the relationships that a fund had with banks prior to the crisis. These relationships are very sticky. They do not change over time. Certainly, there are no new relationships formed during the crisis period. And we are going to focus on funds that have at least 2 bank relationships, because we want to take advantage of the Kwajalein methodology and control for fund-specific effects in our regressions, so that we control for the fund level demand for funds, and we can focus on the cross-sectional differences across banks in terms of their supply of repo funding to mutual funds. So that's exactly what we are going to do. We are going to compare repo lending across banks to the same fund with higher and lower exposure to the pandemic-induced liquidity crisis, the dash for cash. And again, we're going to look at their exposure ex ante as of January 2020. We're going to look at 2 different cross-sectional splits for banks, one based on the commercial paper rollover, and the other based on the excess reserve holdings. So let me tell you a bit about these cross-sectional splits. We think it's interesting to look at the commercial paper market because commercial paper issuance came pretty much to a standstill by the middle of March of 2020. And this is a chart that illustrates that. It shows you bank commercial paper issuance between January and June of 2020. And you see that by mid-March of 2020, basically the issuance of bank commercial paper was 0. And so what we are going to do is we're going to take the set of banks that transact with funds in the repo market. They have relationships. And we're going to split them into 2 groups according to the amount of bank commercial paper they have maturing over February to April period. We will make it as a ratio to total assets to normalize it to the bank size. And we are going to take banks that are more exposed to commercial paper maturing coming up for rollover, and those that are less exposed to that. And this is going to be a measure of funding liquidity needs for a bank in the commercial paper market. So that's one split that we explore. Another split that we explore is the split on excess reserves. We're going to take the amount of excess reserves, meaning the amount of central bank liquidity banks hold in excess of the minimum reserve requirement. And we're going to take that amount, again, ratio to total assets, that they held ex ante as of January 2020. This is going to be our measure of readily available liquidity for bank. Central bank reserves is the most liquid asset you can imagine for a bank. So this is sort of how much buffer it had when the crisis, this aggregate liquidity crisis hit in March 2020, how much buffer it had in terms of central bank liquidity to use either for its own needs or to provide liquidity to others. Armed with these 2 splits, we are going to test how bank repo lending to funds changed. First, following the announcement of these new liquidity providing operations, the bridge LTROs, compared to the previous week. And 2, following the settlement of the first bridge LTRO, settlement meaning the money borrowed actually arrived on bank balance sheets and were available to banks for usage. It is also the same week where PEP was announced, so we're going to compare what happened in that week compared to the previous week. The hypothesis we have in the background is that banks more exposed to March 2020 liquidity crisis should be relatively more affected by central bank liquidity provision because their constraints should be relaxed more. So first question is, what was the impact of bridge LTRO announcement on the March 12th? And the short answer is, well, nothing much happened. We find no evidence of a positive effect on bank repo lending to funds across our more or less exposed banks, regardless of the split, cross-sectional split that we employ. So basically, the pure announcement that these operations will take place had no effect on bank repo lending to funds. What about the settlement of the first operation? Remember, these operations were run weekly. So we're going to look at the first bridge LTRO, which had by far the largest bank sign-up participation. And this is also the week where PEP was announced. So we're going to compare what happened in that week in terms of bank repo lending to funds compared to the previous week. We're going to look at 2 splits, the commercial paper split and excess reserve split. We have our exposure dummy, how exposed the bank was to either commercial paper rollover or how much excess reserves it held ex ante. And we're going to look at 2 measures of repo market activity. One is the volume of transactions over the week. So think of it as a flow of transactions over the week. And another one is sort of a stock variable, the change in the amount outstanding of repos week on week. Regardless of what split we are looking at or what measure of repo activity we consider, there is an increase in repo lending to funds in this week compared to the previous week by the more exposed group. So more exposed banks do lend more. Their repo transaction volumes go up by 2.44% if we consider commercial paper split, by 1.64% if you consider excess reserve split. Also, the amount outstanding of repos go up by 1.87% for commercial paper split, 1.65% for excess reserve split. So it does seem that in that week, more exposed banks did lend more to funds. Now, there are two things that happened in that week, which is there was this big PEP announcement and there was this LTRO settlement. So which one really is giving us this increase in lending by the more exposed group, you might wonder. The way we want to get at that question is to look at the actual take-up of LTRO liquidity by banks. So we're going to take the group of banks that actually did come to LTRO and borrowed liquidity in that week. And we're going to interact that LTRO take-up dummy with our exposure dummy to see whether banks that were more exposed and actually came to the operations changed their lending behavior in the repo market. Now, of course, I have to say that the decision to come to the operations is endogenous. The bank decides whether to come or not. All banks have access. So with that said, what we find is that indeed banks that are more exposed, that took up bridge LTRO funding, increase their repo transaction volumes vis-a-vis mutual funds by 3% when we look at commercial paper split, or by more than 4% if we look to excess reserve split, compared to the exposed banks that did not come to LTRO. So again, it does suggest that LTRO as such had an effect on bank repo lending to funds, at least in terms of supporting the transaction volumes. Given that the amount outstanding didn't change, we don't find any significant effect. It seems that the liquidity acquired from the central bank was used by banks to roll over existing credit vis-a-vis funds. So what does this mean in terms of sort of implications of this work? We started off by asking...
just very quickly, so just a few minutes and then wrap up, sort of, just to...
Yes, it's my last slide. So we started off by asking whether mutual funds should have direct access to the lender of last resort. And, you know, there are different ways how to grant that access. The ones that were discussed, for example, were making funds eligible central bank counterparties so that they come to the liquidity providing operations directly. Another one is to create a new dedicated credit facility for funds, or make fund shares eligible for central bank purchases, or in fact take their shares as collateral in central bank operations. Now, all of these ways of granting funds access to the lender of last resort has costs. We heard it from Iman on Monday. There are huge operational challenges to make this work, but also, as we heard from Ralf's presentation, there are additional risk-taking, moral hazard, and so on. What we try to do in this paper is to say the following: what if we don't do any of these new things? What if we just see how the existing toolkit worked out during this unprecedented liquidity crisis in March 2020? And what we find is that the existing toolkit was actually helpful in terms of alleviating liquidity crisis for funds. Their performance improved upon PEP announcement, their outflow stabilized upon PEP announcement, and with LTROs, bank repo lending to funds was supported. So as we think about the cost benefit of allowing potentially non-banks to access the lender of last resort, I think it would be interesting to take these findings into account for this trade-off between costs and benefits. Thank you so much. Let me stop here. Look very much forward to your comments.
Thank you, Marie. The discussant is Kairong Xiao.
Thank you so much. Thanks, Adrian and Magnus and Quentin, for the invitation to discuss this very interesting paper. So I will start by I'll give you a background of the central question of this paper. So historically, central banks are designed to be the bank of banks, So as Marie just pointed out, non-banks such as bond mutual funds have become increasingly important in liquidity transformation, and they do run into liquidity troubles during crisis, as we have witnessed in March last year. So the question that this paper raised is, should central bank consider becoming lender of last resort to those non-banks? And the answer they provide is no. And the reason is that they document that the central bank intervention can mitigate this liquidity crisis in the non-bank sector via existing tools. So we don't have to, start new things which we haven't tried or have other issues. So they reached this result through two main findings. Firstly, they find that the mutual funds in the euro area benefit tremendously from asset purchases. So this is consistent with some of the prior work or contemporaneous work in using US data, although I think Marie's paper using a very clever identification, I think that's an improvement on the literature. And the second finding is that they find that funds benefit from the central bank liquidity through banks repo. And I think this is an understudied channel because a lot of people had the impression that mutual fund actually cannot take leverage. So if you do look at mutual fund regulation, mutual fund cannot issue debt. They cannot issue debt securities, but they can borrow. And there's a leverage limit on that. And I think, this paper highlights, this is a very important channel, not only for normal times where mutual fund can get liquidity, but also kind of a crisis amplification channel. But third, it is also a channel through which central bank can channel liquidity to non-bank sector, even if they don't have direct access. So I think this is a very important contribution to the literature, not only on, the central banking and crisis, and also the general literature on the interaction and interdependence of banks and non-banks. So I think this is a great point this paper makes. So here are my main comments and suggestions. So firstly, I would suggest the authors to dig deeper on the bank fund repo transactions. I think there are a lot of potential in that direction. And also I have some suggestions on the empirical design for the bank fund repo lending test. And lastly, I would also want to push the authors to think more about the magnitude and the efficiency of the existing policies. So let me start with the first one, digging deeper on bank fund repo transactions. So I think the favorite graph I like about this paper is this graph, which documents the amount of lending from bank to funds through repo transactions. And as I just mentioned before, right, a lot of people are actually not aware of banks are actually lending to mutual funds. They don't even know that mutual funds can borrow money, and this is an understudied point in the literature. So I think I applaud to the authors by really highlighting this fact. And also the prior literature on the fragility of mutual funds usually focused on kind of the liquidity issue induced by redemption, whereas this paper also highlights this issue that if mutual funds rely on bank lending in normal times, and this lending actually decreases significantly during crisis, this actually can exacerbate the liquidity issue for mutual funds. So this is kind of a normal channel through which mutual fund can have instability. So I think this is something that the papers can highlight more. And also this is consistent with the theory paper by Adrian and Quentin with their co-authors on the interaction between banks and non-banks, where they highlight that the banks lending liquidity to non-bank sector may decrease in crisis. So I think this is a really nice fact. So the first comment is that I would suggest the authors to dig deeper on the bank fund repo transactions, because I think there are a lot of open questions. Firstly, what's the fraction of funds actually borrow from banks, right? So, and how much do they borrow from banks relative to the kind of redemptions in normal times and in crisis time? And lastly, I think in the literature, people usually focus on other kind of liquidity management tools for mutual funds like cash holding and treasuries and highly rated corporate bonds as liquidity buffer, and also inter-fund lending in the mutual fund families. And I think we want to get a sense of how important bank lending is for mutual fund liquidity management. Is it really important? It's like accounts for like 50% of the liquidity, that that funds can access to, or just like 5%. So give some of those magnitude will be helpful for us to appreciate the importance of this channel. And also, the paper also exploits the relationship between bank and fund. And I would be interested to know what happens if the fund do not have existing relationship to banks. Is it, during the crisis, is that easy for them to establish this relationship? Say if there's a fund in the same fund family who have existing relationship, so can they just like access through their management firm to get access to the bank, or they have to establish the relationship by the fund itself? So there are these questions on, essentially what's the friction in this market. And so that's kind of related to my last point, which I will highlight later. But I guess that the central question is the pass-through of central bank liquidity via bank repo market to funds is it frictionless? Or if not, what are the major frictions, right? Is that economic, like in the uncertainty of the collateral value, or the transaction cost, or the regulatory, like, we do see that banks have borrowing constraints through regulation. They cannot borrow more than a third of the asset value. Is that constraint a meaningful one? And for banks, they have capital and liquidity regulation. So would that constrain banks' supply of liquidity to mutual funds? So that's my first point. And my second point is about the empirical design for bank fund lending test. So here the goal, we want to kind of understand is what are the effects of the central bank intervention. And the ideal experiment to really kind of show this effect is that we want to have a cross-section of banks. They are facing the same adverse shock. And some of the bank have access to central bank liquidity, but some don't. Therefore, you can look at those who have the access and see kind of whether they are doing better and then more to mutual funds. So example of this, which is also cited in this paper, is Damoni and Ronesti. So what they do is they look at QE and they look at banks which have relatively more MBS in their portfolio so that they can kind of get better access to the central bank liquidity provision. So they compare the banks afterwards. So this paper is doing something slightly different, which I think may not be ideal. So what the paper is doing is by split by banks by their reliance on commercial paper, and they also do a second split by the amount of access reserve they have. But these two things are very similar. So the point that the paper makes is that high reliance banks have greater exposure to COVID-19 crisis because of the disruption in the commercial paper market. And then they compare banks with high reliance versus low reliance. So my concern is that this treatment actually measures the effect of COVID-19 crisis, not the central bank liquidity. So if you combine this with post-dummy of the post-policy intervention, so essentially you are comparing essentially kind of the negative effect of the COVID-19 crisis after the policy announcement. So it's a little bit contaminated with the exposure to COVID-19 crisis. So my suggestion would be, if your goal is to understand the effect of central bank intervention, maybe using the fraction of eligible collateral for government liquidity program to define treatment will be more appropriate. So my last comment is on the magnitude and efficiency of this channel. So back to the main question raised by this paper, should central bank consider becoming lender of last resort to non-banks? And what the paper shows is that the non-banks benefit from the existing tools, but the question is whether this is enough. I think it is pretty much open questions. I do not expect the paper to provide a definite answer, but I think more effort along this line will definitely improve the contribution of this paper. So what are the open questions? Firstly, do they actually get enough liquidity through this indirect channel? So I think, based on Ralf's presentation, right? So we know that the direct channel, there are some frictions out there, but this indirect channel through banks or through asset purchases also have some issues. So firstly, the funds may not have eligible collateral or assets that can benefit from the central bank asset purchases or those indirect channels through banks. And also funds may not have prior relationship with banks. And even if they do, banks may have market power or regulatory constraints so that this transmission is imperfect. So in fact, if we believe the transmission is frictionless, so the empirical test in this paper will not work in the first place, right? So because we're always comparing some funds have better access than not, that is by default saying that funds do not have as good as access to central bank through these indirect channels. They tend to perform worse, which essentially suggests that maybe those indirect channels may have a lot of frictions. So the transmission in the data is imperfect and even uneven across funds. So maybe alternative policies may be useful, especially for those smaller funds. And second, the second kind of issue is about efficiency, right? So we show that the existing tools works, but is it more effective than alternative policy like direct access? So this reminds me of older kind of debate in TARP in the Great Financial Crisis. There, I remember reading, this discussion about, whether we should have direct equity injection to banks or should the government just purchase their bad assets. And at the beginning, I think a lot of those policymakers think about asset purchases because that's more neutral. It's not really kind of putting taxpayers' money in banks' pocket. But later on, they gear towards equity injection in the end because at least you can get more bang from the bucks by directly injecting the money into banks because you get this leverage effect. So we can kind of see a similar debate pan out in this non-bank case where we can think about maybe an indirect approach could be more effective. So imagine a counterfactual world where all the bond mutual funds have direct access to central bank discount windows. Maybe there's no wrong in the first place, like what happens for the banking sector today. So again, this is kind of a pretty much open question, but I would just suggest the authors to really think about, even if the current policy, existing tools works, is that enough? Is that efficient compared to the counterfactuals? So again, let me summarize. I think this paper provides a timely study on a very important topic. And I really like the asset purchase result because that, it provide a very clean identification and consistent with the results in the US. But I like the evidence on bank repo lending more because I think it's very unique setting, really unique data, and it's understudied area in the literature. I would imagine it could become a major contribution to the literature. So to summarize my suggestion, I think it will be beneficial to dig deeper on this bank lending repo transactions because there are a lot of unknowns, and I think the authors are in the good position to shed more light on this area. And also, it may be helpful to improve the empirical design for the bank fund repo lending test. And lastly, think about the magnitude and efficiency of this indirect access. Overall, great paper, and I think they will stimulate more research on this topic. Thank you so much.
Great, thank you. We have a couple of hands up, and so Marie, if you briefly want to respond, or if you want to take questions directly from participants.
I'm happy if we collect questions and then I try to speak to those that I can answer readily.
All right, so we have Quentin, Adrian, Sebastian, and then we have also in the chat. So Quentin, please.
Yes, thanks, Mary. Thanks, Kairong, for the discussion as well. So one of the arguments in favor of providing this lender of last resort function directly to the non-banks, that banks can be potentially constrained by regulation, or by maybe by something else as well. But that's potentially one argument. So I was wondering if you thought about maybe looking at some heterogeneity in terms of how close the banks are to these regulatory constraints. So, and probably the main constraint that people would have in mind is some capital constraint, some leverage ratio or something like that. Things could be quite interesting.
Should we let Adrian in and then you respond to everyone, Marie? Is that fine with you?
Yes, so we just have two clarifying questions. So if I understand correctly, the gap for mutual funds after a long period closes. I was wondering if it's with respect to all metrics. For example, does it mean that there is a reversal of flows for the funds that have less eligible collateral after 3 weeks, or is there like maybe to make some more losses during that period? And then would you agree that when you do the definitive, they might still have, when you look at the fund that have less eligible bonds, they might still benefit from the intervention through general equilibrium effect, I guess. And I understand that you might not be able to measure that, but maybe you have a sense of how it looks like in the data.
Sebastian?
Yeah, I just really wanted to echo what Kairong and Quentin raised, the issue of capital. I mean, to the ability that banks can channel these funds, it seems that their capitalization is tremendously important. So a very simple empirical strategy is just separate your banks from high capital, low capital. You may not have to take a stand on regulation or not, but it seems that their ability to intermediate really depends on that. And so it would be interesting to see. Thanks.
And Marie, I can also, I don't know if you've seen the chat, but the question is if you have an opinion on the economies where non-bank market players do not make much of the liquidity market, and are there any early signs of liquidity crisis arising from non-bank players in such a scenario? You can answer all the questions and give a response the way you want now.
Thanks so much, Novi. Thanks so much to everybody, and particularly to Kairong for really a fantastic discussion. It's extremely helpful to us. So please do send me your slides, and I hope we'll chat more later as well. Too many questions to answer in, I guess, 2 minutes that I have. Let me very quickly react to this idea of capital constraints. I think it's a great one. So one thing, we do control for capital in our regressions. But second, let me say the following. We know, and I've done some work on it myself, that leverage ratio has a big impact on repo market, but it's the borrowing that affects leverage ratio. Lending transactions in repo market do not affect leverage ratio, and we are looking only at the lending side. Okay, so for us, it's not going to be so helpful, I think, to look at the sort of leverage in terms of lending, because it has no impact on bank leverage whatsoever. So that's one point. A second point that but I mean, it's an interesting idea. Maybe you should think about it more. But it's not quite clear to me exactly whether the leverage ratio as such would be a constraint in terms of lending in the repo market. It was a constraint that played a big role, for example, in terms of banks taking on and purchasing some of the securities being sold by the funds, but maybe less so in this particular market we are looking at. On Adrian's question on the reversal of flows, we do see outflows in mid-March. We also see outflows still until the end of March, net outflows for both groups of funds, but much lower outflows for those that have more PEP eligible assets. And by the end of March, we don't see outflows in either group of funds anymore. So it's really, the intervention did stabilize, and indeed, you're hinting at that. It also stabilized and helped, I think, the funds that had less PEP eligible assets. So there were spillovers. And we know that from other programs, there are spillovers also to non-eligible or less eligible assets when the central bank does asset purchases. To Kairong's points, many of them to think about. Also an excellent point on maybe an alternative split, again, coming up in terms of the collateral constraint for the central bank purchases. Now, I have to say, all of the banks in our data set are large dealers. And the ECB takes a huge range of collateral in its operations, including you can pledge loans. So it is true that some small banks may be collateral constrained, but I would have to see whether these big banks we are looking at could be collateral constrained. Would be a great split. I completely agree. Maybe I should stop here. I would love to chat more about all the other points, which were fantastic, and we will think really deeply about all of them, including the leverage ratio and capital constraint points, and we'll take this into account in the next revision. Thanks so much for everybody for great comments. Thank you.
All right, thank you, Marie. I can also inform everyone that there's a chance to continue the discussion in the breakout session or breakout rooms after the session. So, but let's move to the third paper. And it is Systemic Risk and Monetary Policy, the haircut gap channel of the lender of last resort. And Martina Jasova will present. Please go ahead.
Thank you so much. Can you see my screen and can you hear me well?
Yes, perfect.
Okay, perfect. Okay, fantastic. So I'd like to start by thanking the organizers for including our paper in this fantastic conference. We're really happy to be here today. And so today I'm going to be presenting a work, Systemic Risk and Monetary Policy, which is a joint work with Luke Levin and Caterina Mendicino, who are at the ECB, Jose Luis Pedro from Imperial, and Dominic Supera, who's at Wharton. Now, as Luke and Caterina are with the ECB, the standard disclaimer applies. These are our views only, not necessarily those of the ECB and the Eurosystem. So for this very audience, I don't think I need to motivate too much about the importance of the lender of last resort. We've been talking about it for the past couple of days, and I guess we all agree that we have seen the lender of last resort policies becoming more and more important, especially after the global financial crisis, but also in response to the COVID-19 pandemic. Now, historically, there has always been a very active debate about the implications of the lender of last resort policy on aspects such as moral hazard or exposing the central bank to undue credit risk. Now, in this paper, we're going to take a slightly different angle, and specifically, we're going to focus on the following. We know that banks access liquidity facilities at lender of last resort by posting securities as collateral. And as a result, this can mean that lender of last resort could potentially affect bank interlinkages through these common collateral exposures. And that's where we want to go with this paper. So let me be more formal. The question that we are really trying to answer in this paper is, does lender of last resort policy affect interconnectedness and potentially systemic risk in the banking sector? And we're going to go around answering this question by looking into a measure of a haircut gap. And we're going to be thinking as a haircut gap as a lender of last resort policy tool. I'm going to explain the haircut gap in great detail in just a couple of slides, but let me tell you right now that you can think of it as a difference in haircuts applied by the private market and by the central bank on repo operations on bonds that are being pledged. I'm going to start with using all types of collateral that can be pledged, but then we're going to focus very quickly on the role of the bank bonds. Our motivation to understand the role of bank bonds is essentially twofold. One is, as I'll show you, bank bonds are a very important source of collateral, especially in Eurozone. Approximately 50% of pledged collateral in the height of the sovereign debt crisis were bonds issued by banking institutions. The second thing is that we know quite a lot about the role of the treasuries as a collateral, and the role of bank bonds have not really been studied enough in the literature. So we want to shed a little bit more light on this margin as well. So as I already alluded to, we're going to use a micro level data from Europe, where we will put together a data set using both confidential ECB data sources and private repo markets. And this is going to allow us to observe the behavior of more than 300 Eurozone banks pledging more than 20,000 unique bonds. And specifically, we're going to draw our attention to the period of the sovereign debt crisis, when we know that lender of last resort played a very important role in Eurozone. So before I jump into the details of the paper, let me give you a big highlight of our results. So as I mentioned, we document the haircut gap channel of lender of last resort policy, and we do it in a couple of ways. The first thing that we show is that lender of last resort incentivizes banks to increase holding and pledging of bonds, especially those that feature high haircut gaps. Now, importantly, we see this increase of holdings only by banks, meaning only by the sector that has access to LOLR facilities. We don't observe such behavior for other financial intermediaries. The second thing is that when we see that all high haircut gap bonds are being more pledged with the lender of last resort, but within these all types of asset classes, we see that the behavior is the strongest for bank bonds, especially those issued by other interconnected banks. This brings me to the second point. We focus on the bank bonds, and we show that the lender of last resort contributes to the buildup of the systemic risk at the margin. Here, I want to be careful about what we actually find in the paper. We're not saying that the lender of last resort is increasing the systemic risk, but on aggregate, but we're showing that lender of last resort contributes to new interconnectedness that are significant. And what are these specific new margins that we uncover? The first one is that we find that there's an increase in interconnectedness across similar banks. And we measure similarity in a couple of ways. For example, when the issuing and pledging institution have correlated bond prices, or when the issuing and pledging institutions come from the same national market. The second thing that we show is that there is a higher pledging of bonds that are being issued by systemically important banks. And the final thing we find is that on the top of all of this, we see that banks also increase direct debt cross-holding. Now, what is what I call here direct debt cross-holding? That's the case that imagine Magnus and I are two banks. He's going to issue bonds. I'm going to issue bonds. I'm going to buy his and pledge his bonds. He's going to buy my bonds and pledge my bonds with the ECB. That's what I call the cross-holding here. Now, in addition to all of these demand effects, we also turn our attention to the supply side of all of this. And I'll probably won't have too much time to show you this today, but we have it in the paper. And we show that on the top of all of these, lender of last resort also stimulates issuances of the new bank debt that is associated with high haircut gaps. Okay, so there are a lot of people on this Zoom that have largely been working on this field, and I'm not going to do justice to the literature, but let me just say a couple of things. What we really think where our contribution lies is that we uncover the link between haircuts and interconnectedness, which allows us to speak to a previously undocumented effect of the lender of last resort. We also show that while the existing literature has studied the systemic risk that gets created in the interbank market, we show that a systemic risk can also arise from cross-holding of bank bonds. Now, very importantly, a lot of our understanding on lender of last resort policies comes from understanding the sovereign and bank risk nexus. So banks are pledging government treasuries. And what we show that there is also a big importance of the bank bonds that are not only being pledged with lender of last resort, but as I'll show you, they even I think exhibit even higher sensitivity. And finally, we know that monetary policy induces individual risk-taking from a number of papers I'm listing here, but many, many more. What we are showing is that monetary policy can potentially also contribute to more of a systemic-wide risk-taking. So what I'm going to do in the next couple of minutes is that I'm going to give you a very brief overview of the data and institutional background / stylized facts that we were originally not aware of when we started this project. And I'm going to move to a more formal analysis, and I'll first use the entire sample. And then I'm going to show you results when we use a more targeted identification strategies using the ECB haircut rules. So let me dive right in. So a few words about the data. We build a micro level data set that really allows us to observe all of the things that I've just mentioned. On the top of it, we're gonna exploit the central bank liquidity and collateral data, which essentially allows us to see what types of securities are banks pledging with the lender of last resort to get the liquidity. And most importantly, this data comes at the ISIN level, allowing us to observe more than 300 banks from 19 Eurozone countries pledging all of these securities. And importantly for us is that for all of these ISIN, we're going to be seeing the haircuts that the ECB is charging when the banks access the liquidity facility. Now, the second thing is we're going to match this lender of last resort liquidity with the private repo market. So again, for all the ISINs, we are going to be seeing the haircuts that the private markets are charging. And this is going to be the core of our data set. In addition to that, we're going to complement it with additional information on ratings, as well as bank level information coming from balance sheet, their ownership structure, and other things I'll talk about later. Finally, for our external validity exercise, I'm going to bring in other sectors, not just banks, and we're going to observe what's the changes in the dynamics of the security holdings in banks vis-a-vis other sectors that don't have access to LOLR using the SHS data from the ECB. All right, so I already mentioned the fact that we're going to use haircut gap as a measure of lender of last resort policy. So let me be more explicit. The way we measure the haircut gap for an ISIN S at the month T is that we take a difference of the haircut that is charged by the private market minus the haircut that is charged by the central bank. And that's going to be our measure of the haircut gap. Let me show you how this looks. So in these graphs, I'm plotting you the evolution of haircuts in the left-hand side for a representative category. And these are uncovered bank bonds with 1 to 3 year residual maturity and fixed coupon. And you see two lines. The red line is showing you the haircuts that are charged by the European Central Bank for every different rating notch. The blue lines are the average haircuts charged by the private market. Now, notice that the blue line is always above the red line, but also what we call a haircut gap is essentially the vertical difference between the two spots. And the vertical difference is plotted for you also on the right side of this graph. And what you see especially is that we observe the highest haircut gaps for the securities that are the riskiest, so for the BBB rated securities. Now, another way how to plot this data is to plot it over time. So here I'm showing you the evolution of haircut gaps over time, and I'm splitting the securities as to whether they were issued by the core or by the periphery of Eurozone. And what you can really see very nicely from here is that we observe highest haircut gaps on securities issued by Eurozone periphery, especially in the height of the sovereign debt crisis. Now, let me shift the gears a little bit and tell you a little bit more about bank bonds. So one thing that's really interesting about bank bonds is that bank bonds are massively held inside of the banking sector. In this graph, I'm showing you the holdings of bank bonds across a number of sectors. And you see, by and large, the holding of bank bonds are concentrated inside of the banking sector. This picture would look very different if you look into the holdings of government bonds. Government bonds are largely held not only by banks, but also by mutual funds, insurance companies, and pension funds, and et cetera, et cetera. So because bank bonds are so heavily present on bank balance sheet, is it perhaps unsurprising that bank bonds are also used as a collateral by these banks? So in this graph, I'm showing you the securities that are being pledged with the ECB to receive lender of last resort liquidity. And the blue shaded area is the importance of government issued securities. And you really see that government bonds are important. They're always very, very important. And we know a lot about the role of government bonds in the literature. But one thing where I want to draw your attention is the red shaded area. And these are the securities issued by banks. And you see, if anything, the bank issued securities are even more important when it comes to the use as a collateral to receive lender of last resort liquidity. So let me now take this red shaded area and let me decompose it a little bit more. So here I'm splitting the previous red shaded area into 4 groups. And what you can really see that the part that is driving these bank bonds is the pledging of bank bonds issued at Eurozone periphery by other domestic institutions. So that's the green shaded area right here. Now, let me, until now, I was talking about pledging of bonds. Let me make one more connection, and that is that this behavior of pledging is largely connected to the behavior of bank holdings. So in this graph, I'm showing you the dynamics, and you largely see that the dynamics of the pledging and holding seem to correspond very, very largely. And again, the domestic peripheral bonds are being held the most. The other things is in terms of magnitude and timing, this is also the case. 90% of bonds that are held by banks are being pledged with the ECB. And these bonds are for the first time parked at the ECB facilities approximately within first 3 months after the issuance. So you can see that the holdings and the pledging largely move hand in hand. So what I'm going to do with the rest of my time, I want to move a little bit more to the formal analysis. And I'm going to start with using the full sample of securities. So let me first talk a little bit about the regression I'll be running. So I'm going to be exploiting the variation in the haircut gap, at first, both at the cross-section of securities and also over time. So that's going to be the haircut gap right here. And I'm going to be interested in how does the size of the haircut gap affect the pledging behavior of the ISIN level security S by bank B in time T. And I'm going to rescale it to the total value outstanding of the security just to make things better understandable. Now, in addition to these average effects, I'm also going to go after specific heterogeneous responses of the pledging behavior. And these heterogeneous responses here are denoted as H, and I'm going to be looking at things as to, are the bonds that are being pledged more domestic? Are they more similar? Are there bank versus government? And so on and so forth. Now, to get a little bit more identification out of this, I'm going to saturate this with fixed effects and control variables. Specifically, I'm going to control for time fixed effects, bank fixed effects, and then I'm going to control for ISIN level fixed effect to capture some security characteristics such as the issuer, coupon payments, existence of guarantees. I'm going to control for rating group fixed effects to absorb time varying riskiness of a pledge asset. And I'm going to introduce additional time varying security controls such as residual maturity or price. Now, in the main sample, we are going to be looking into the period from January 2009 up till March 2015. We're going to stop in March 2015 because this is the start of the quantitative easing in Europe, and we just want to be sure that this does not compound our analysis. So first thing I'm going to do, I'm going to take both government and bank bonds together, and the heterogeneity I'm going to introduce is going to be dummy bank bond, which takes a value of 1 if a bond is a bank bond and 0 if it's a government bond. So you can see a couple of things. First thing is that you can see is that following an increase in the haircut gap, we see that the banks are pledging more of these securities with the lender of last resort. Now, in addition to this average effect, you see that bank bonds actually exhibit a higher sensitivity than government bonds. And this can be related to the fact that I already mentioned, which is that the bank bonds are heavily held by other banks that have access to lender of last resort facilities. And as a result, it's reasonable to assume that they are more sensitive to changes in the haircut gap. Now, given that the bank bonds are so important, let me zoom into the category of bank bonds more, and let's unpack this a little bit further. So I'm going to go within the bank bonds, and I'm going to explore additional heterogeneities. Now, the big question is, what type of heterogeneities do I have in mind? So guided by the theoretical literature, I'm going to look into the two margins. The first one is the discussion between similarity and risk sharing. So there's a strand of literature arguing that banks should be more likely to hold bonds issued by similar banks, which is motivated by information frictions and peer monitoring literature. So banks are better monitor banks that are similar to them, and as a result, they might be willing to increase their loadings of bonds issued by similar institutions. On the flip side, you can also imagine that the banks might be willing to increase their linkages towards different banks in line with the risk sharing motives literature. The second margin I'm going to look at is related to the bailout expectation theory. And according to this strand of literature, you can think that in the event of a systemic crisis, banks might be more willing to increase linkages towards systemically important banks, in other words, too big to fail banks, or cross-pledging of the bank bonds, which is going to give me a too many to fail problem, as this literature has been arguing. So let's see what we're getting. So let me start with the similarity. In the paper, we come up with a number of measures of similarity, but for the brevity of this talk, let me just use one, and a very obvious one. And I'm going to talk that two banks are similar if they come from the same domestic country. So two French banks are similar, French and German are foreign. Okay, and so what you can see here is that the effect that I was talking about is being largely driven by the pledging of domestic bank bonds. And this is important, especially in Europe, because we know that the European banking sector is still very segmented. And so you can argue that in such segmented banking sector, banks might be better equipped to monitor peers that come from the same market. As I mentioned in the paper, we do other proxies. For example, we construct the correlation coefficient of the prices of the issuing and the pledging bond. And again, we find stronger results for when the issuing and the pledging institutions are more correlated. Now, because I said that the domestic bank bonds are more important, let me go inside of the domestic banks and unpack this a little bit more when thinking about this bailout expectation theory. In other words, the hypothesis I want to test here is that within the domestic banks, I should observe that higher haircut gaps provide incentives to banks to pledge bonds issued by other systemically important banks. Again, there are many ways how you can measure systemic importance of the bank. We do lots of things in the paper. Let me just for simplicity say that I'm going to use an S risk of an issuing institution. And so I'm going to introduce this triple interaction of S risk, domestic, and haircut gap. What we find is not only the domestic margin is important, but within the domestic bonds, the banks are really loading up on securities that are being issued by systemically important domestic banks. And that's the result I'm showing here on the graph. So I'm not going to go into any of the robustness, but I'm going to use my last minute to tell you a little bit more about additional things we do in the paper. So as of now, I was talking about the entire sample. Now in the paper, we go after two specific identification strategies that allow us to go a little bit more deeper into the causality. So let me tell you a little bit more about it. This is the graphs that you've seen in the beginning of my presentation. And notice one more thing. If you look into the ECB haircuts, they are very insensitive to rating. ECB essentially applies only two levels, a lower one for all A notches and a higher one for all B notches. And the private markets are much more nonlinear and continuous. So what we can use this is for our first identification strategy, where we exploit these kinks and jumps in the haircut gap. So for example, we look at all the securities that are being downgraded, but notice that a downgrade, for example, from A to A minus increases the haircut gap by 6 percentage points, but the downgrade from A minus to triple B only by 4 percentage points. So we can focus on these things and measure that following a one-notch downgrade, pledging of the bank bonds with the lender of last resort should increase by more at the rating notches that trigger larger jumps in the haircut gap. And that's the first strategy we go after. The second one is using only this A minus notch. So this is the only case when ECB is moving to a higher haircut gap, to a higher haircut. But the important thing about the A minus notch is that the ECB is only moving to a higher haircut only if all 4 rating agencies that are listed here downgrade the security to a triple B plus or lower, which means this allows us to look only at securities at A minus and distinguish 2 types of downgrades: binding downgrades, when all 4 downgrades move, so ECB is forced to move to this higher level, or a non-binding downgrade, meaning at least one of the rating agencies stays put at the A minus, which means ECB can continue to apply a lower haircut gap. And these allow us to test the prediction that non-binding downgrades should provide greater incentives for banks to pledge these downgraded bonds with the lender of last resort as the haircut gap opens much more. Okay.
Just a kind reminder that sort of you have to wrap up.
Yeah, I'm wrapping up. Perfect. So these results are all in the paper and they are exactly consistent with what I showed you on the full sample. So let me just wrap up by saying that in the paper, we show the effects of lender of last resort on bank interconnectedness and the systemic risk. And we argue that bank bonds are very important. And if anything, they have been less understood in the literature as a source of collateral. Now, what I already mentioned, but I want to reiterate is that our results do not imply that lender of last resort increases the systemic risk overall, but instead we want to point out to these interesting margins where the LOLR can encourage direct cross-holding of bank bonds or linking towards similar bank bonds. Okay, thank you.
Excellent, thank you, Martina. And the discussant is Kjell Nyborg. Please, Kjell. You're muted, Kjell.
I know. I was just trying to get the screen set up here. Sorry. First, I want to thank Magnus and Adrian and the organizers for organizing this amazing conference. I really enjoyed it a lot. I thought the panel discussions were amazing and everything. So, and thank you for including me by way of discussing this paper by this quintet of distinguished researchers. So, in my discussion, I want to start a little bit with the context, because I think to me, there's context that is missing from the paper, and this is very important for the narrative. Then I want to go on and talk about some data and analysis issues, some issues with the specifications, and then I have some final comments and suggestions. So my view on monetary policy, and this is the overall context here, is that you can divide it into 3 elements. Interest rates, liquidity policy, and the collateral policy. And collateral policy, of course, extremely important for this paper, because collateral policy governs the terms of exchange between collateral and central bank money issued directly by the central bank. And the point is, of course, that central banks issue money against collateral. So some of you may know I wrote a book about this. I came out a few years ago, and where I particularly studied the Eurosystems and our collateral framework. And the current paper is putting together liquidity policy and collateral policy. And its bottom line conclusion is that if liquidity policy is generous, what the authors call lender of last resort, which I put in quotation marks because I don't really find it really quite applicable in the Paschottian sense. But anyway, then haircut gaps between central bank repos and private repos create systemic risk by way of segmentation. And they show through their regressions that this is driven by banks in periphery countries increasingly pledging domestic bank bonds. So this actually relates very much to my book. So as I mentioned, I discuss collateral and liquidity policies in detail and at length, cruciating detail at some points. And one of the things that I argue is that an accommodated collateral policy impairs market discipline, and can contribute to fragility. And then I say, and this is maybe controversial, but I say that this has been the case in the euro area. And then I say further that an accommodative liquidity policy exacerbates the collateral policy issues. And so the point is that you need to distinguish between collateral policy and liquidity policy. And so my discussion, I want to do that. And I want to start with liquidity policy because it's much easier to discuss. And so this graph is basically an extension from a similar graph in my book. It relates very much to the discussion that we had on Monday about these central bank policies that have led to this extreme amount of excess liquidity, even more than what you see on the graph, because things have moved on. And my take on that discussion was that indeed this is a last resort policy. It's sort of last resort in the sense of the Eagles, the Hotel California. You see this shimmering light in the desert, and it's really attractive. You want to check in, which you can do anytime you want. But when you check in, you find that you can't so easily check out. With respect to the paper, what's important here is that you see there's two kinds of liquidity policies on this graph. The way that the ECB Euro system started out with a corridor system for setting the rates and the liquidity neutral policy. And then in the aftermath of Lehman, it changed this to full allotment policy. So before QE, this was the big policy of the ECB, the full allotment. And this led then to excess liquidity. And if you see the sample period of, and let me just say, this full allotment policy is what the authors call lender of last resort. But of course, it's not lender of last resort in the budget sense. And we can discuss that later. So anyway, what the authors have, they have this narrative where they say lender of last resort policies, i.e. full allotment policies, has these implications, but they don't have a benchmark, because what you see on the bottom, the sample period is only full allotment. It also actually extends into QE. So QE didn't start in March 2015, it started in the fall of 2014, especially in the bank bond space, which is what the authors focus on, so they might want to prune their data period. But anyway, we do have, my main point here is that we cannot attribute what we find in this paper to a full allotment policy because there is no benchmark. So the authors would, they're kind of hell bent on attributing this to the findings to lender of last resort / full allotment, and to counter the argument, what I've just said, that they don't have a data period that goes down into liquidity neutral. They kind of suggest that Eurosystem haircuts matched market haircuts before the full allotment policy. But this is not concordant with the information that I know that is publicly available. So let me just give you some examples. So Boyter and Siebert, I do believe William Boyter know what he's talking about, had a paper in 2005, well before full allotment, well before the crisis, where they basically railed against Eurosystem haircuts being too low for periphery government bonds. And they said this would lead to problems. Meisenzahl et al. Has a paper in the JMCB 2009 using pre-crisis data, where they have evidence that pre-crisis, the Eurosystem haircuts did not equilibrate opportunity costs across different eligible collateral. So that means there's a haircut gap. And in my book, I document that Eurosystem haircuts are revised only every few years. And in particular, relating to the point here, I document that there's no substantial change of this March 2004 to October 2008 period. And this is extremely well documented in ECB Eurosystem documentation. So there is no change in the Eurosystem's haircut. So if the Eurosystem and market haircuts match, then you would have to argue that the markets use the same haircuts day on day for 4 or 5 years, which is not very plausible. Also, the collateral in the Eurosystem is extremely expansive, as we sort of have had allusions to in the last couple of talks. And a large portion of Eurosystem eligible collateral is not used in private repos. There's an eligibility gap. It's huge. And this, I think, is very important for this paper. And this is before crisis and after crisis. Now, if you look at bank behavior with respect to pledging collateral before and after full allotment, you will find that it's very similar. So this is actually done in the paper I've tested out. And so what they show is that for both the liquidity neutral and full allotment time periods, banks pledge relatively low quality collateral on average. And then they find also that banks with worse collateral and in worse financial health have larger liquidity uptakes from the central bank before and after full allotment. So there's no real qualitative effect in the behavior of banks before and after. They economize on collateral because these have different opportunity costs because there's haircut gaps and eligibility gaps. But the full allotment exacerbates the issues because there's more money at stake, more collateral at stake. Now, collateral frameworks do basically two things. One, they define the set of eligible collateral banks can use to obtain central bank money directly from the central bank. And second, they define a rule that determines how much money will be provided per eligible collateral. So in the case of central bank repos, which is what is being studied in this paper, you have this concept of collateral value. This is determined within the collateral framework. And that is just simply the price less a haircut. Now, in the euro area, there are 30 to 40,000 different securities on the public list of eligible collateral, somewhat less before the crisis, before full allotment, but still it's a huge amount. And for anyone who's been studying financial data, you know that that many securities do not trade on a regular basis, and that's also the case here. And we have government bonds to unsecured bank bonds, ABS. And the majority, when you feed in the ISINs on the public list of eligible collateral, which incidentally is a subset of the complete set of eligible collateral, you will find that the majority do not have prices in the Bloomberg system. And this is very important for this paper, for some of the variables, for the interpretation, and also for the haircut gap measure, because the Eurosystem, the ECB, recognizes that this is an issue. So what the ECB says, if there is no price in the market, then we will use a theoretical price. And then over time, they got concerned about this. And so they started to say that, or dictate that if a theoretical price is used, then one should apply a valuation markdown in addition to the haircut. And this valuation markdown does not show up in the public list of eligible collateral. So therefore, it's really like an extra haircut, and this is not included in your measures. At least there's no discussion of this whatsoever. So I presume that it's not included in your measures. That's a huge, estimation error or error of this key variable. And this is especially a concern for bank bonds. And also non-marketable assets like bank loans, as we heard before, can be used and are heavily used in these things. Now, are theoretical prices a concern? Yes. So here's results from a paper that I did some years ago, as I said, and also relating to things I did in the book. I fed, or my team actually, I have to give them credit, fed the ISINs on the public list into Bloomberg, and here are the results with respect to theoretical prices by country and by liquidity category. Let me just point out, unsecured bank bonds are liquidity category 4. In Bloomberg, you will find that 80% of those either have no price or have a theoretical price in Bloomberg, because Bloomberg flags the data source. And for most bonds, the data source that is flagged is a theoretical model. You've got to be really careful when you use this data. Now, they also have data from the ECB, but they need to discuss this, and there's going to be a huge issue with theoretical prices. And you can also see on the right-hand side this issue of theoretical prices varies across countries. So given that segmentation is so important in the paper, this is also very crucial. So this is a serious data issue, I think, and all of us need to do a better job in cleaning that up and taking care of these very important institutional issues. Now, with respect to the haircut gap, it's a bit of a black box how this is calculated. We don't know how eligibility gaps are dealt with. Do they apply 100% haircut, or do they only look at ISINs that they find in the private markets, that they look at Eurex and LCH? I don't know. It's not clear. It's not discussed. And in the markets and on these two exchanges, there are tons of different contracts, different baskets, different tenors. We don't know what they do. And not all of these kind of contracts are really, I think, comparable. But the one contract that I know that is comparable is the GC pooling contracts trading on Eurex, which is part of the data set. And these contracts are designed specifically to dovetail with Eurosystem repos, to such an extent that Eurex has a policy to use the haircuts from the Eurosystem in the GC pooling contracts for the securities that they admit into the contracts, that they don't admit all. And they do that for about 90% of admitted securities. So then there's not much of a haircut gap with respect to those securities. But over time, they have excluded, especially periphery denominated or bonds or domiciled bonds over time, which means that you have effectively 100% haircut. But these issues are really crucial to understand with respect to the haircut gap measure.
Kjell, could I just ask you to use 1 or 2 minutes to wrap up?
I will wrap up. There's also an issue with the composition of the bonds. I'll just give a quick example of this. This looks like an error. So what you see here are the number of eligible collateral on the public list, and you see this big drop and then things coming back. This is documented in my book. These are unsecured bank bonds trading on non-regulated markets. It's hugely important for this paper. And they were put in place to take advantage of the second of the 2-3-year LTROs. I mean, you cannot ignore something like that. And it's predominantly French and Italian stuff that relates to segmentation. Specification, this is my penultimate slide on this. So they run this kind of regressions and different forms, and this is fine. And they find evidence of segmentation when they use domestic and foreign bank bond dummies. But this kind of regression doesn't really adequately control for latent variables for endogeneity issues. Fixed effect is not enough. And so they try to deal with that by limiting the sample to threshold downgrade periods, but they don't do a diff and diff. I think you need to do a diff and diff to cement that what you find is actual. So currently there's an endogeneity issue in the regressions that needs to be dealt with. The only way to do that is diff and diff. And I think when you do that, I would really recommend that you differentiate between covered bonds and unsecured bank bonds. These are different things. They're treated very differently everywhere and in the collateral framework too. And Lentner 2021 actually did analysis based on these pivotal A- rating threshold downgrades for banks. And he shows that this leads to an increase in covered bond and a decrease in unsecured bond issues after these pivotal downgrades, so that these downgrades affect the composition of bonds. And this is very important to recognize. So now this is my final slide. So I think the paper fits into the collateral policy literature. The underlying idea relates very much to Meisenzahl et al. 2009. Banks economize on collateral, and haircuts do not equilibrate opportunity costs. There are gaps. They were before as well as after full allotment. And the basic findings are that this may lead to systemic issues is very much related to the points I make in my book. So I talk about market discipline, but I also talk about segmentation. So these are not new ideas. But I do think econometrically we need more work to establish the link in this paper to the haircut gap and the segmentation systemic risk point. The data needs more attention, the econometrics need more attention, and the narrative needs attention. You cannot conclude what you want to conclude with this kind of data because you don't have a benchmark.
All right.
And so my suggestions, let me give my suggestions, Magnus. It's like 30 seconds. So first, show the underlying data. This is amazing data. Show us the data. Start analysis with statistics on segmentation, because that's where you end up. And then design a dip test to see if haircut gap contributes to segmentation. And then also consider the eligibility gap, because after all, and you got to remember this, and you can see this in statistics, you can see this in graphs that I put out. Pledging of non-marketable collateral increased over time. And so essentially what you're saying is this translates over to marketable collateral. So we need to know about the eligibility gap too. That's all I have to say. Thanks.
All right. We take the time for a discussion and for Martina to respond if you would like to. So please raise your hands or put something in the chat if you would like to ask Martina something. In the meantime, Martina, if there's anything you would like to respond to in the discussion.
Yeah, absolutely. I can start responding, and if anybody has questions, just feel free to jump in. So first of all, thank you so much for a fantastic discussion. This is incredibly helpful, and we really appreciate your time. We know that you spend a lot of time thinking about this topic, so this is really, really helpful for us, and we'll do our best to address the comments. And I think this was very, very valuable, and your points are super well taken. Let me just say a few things on the things that your last slide, showing the data. I'd love to. I just don't think how much we're allowed to from the ECB. So we need to kind of strike a compromise to see, like, maybe on the segmentation, we might be able to show a little bit more, but we'll see what we can do in showing more of the underlying data. On the diff and diff, I think that's a fantastic idea. We already tried to do a little bit with these additional haircut ECB haircut rules. And I think the closest we get to the diff and diff, and we can definitely work on it more, is that when we compare the pledging behavior or holding behavior of banks and non-banks. And what we really see is that increasing the haircut gap is increasing primarily the holdings only of the banking sector. And we don't see so much of, say, pension funds, mutual funds, and other sectors that don't have access to the LOLR facility. And within that, I think we can also do more in terms of diff and diff and show it over time, show the parallel trends, and so on and so forth. The final thing I'm going to mention was on the collateral. So the non-market collateral is, to my surprise, quite little over this period. So as you might know, the ACC additional credit claims shoot up a little bit after the LTRO. But then in the aggregate, we used to have them in the graph. They are around 5% of the actually pledged collateral. So when we see what banks actually pledged, we see that it's around 5% of the entire collateral. We can definitely add it to the graph. Right now, we're just showing the marketable collateral, because we want to think about the collateral that you can either go with the lender of last resort, or you can go with the private market. And actually, this brings me to the question you asked: how do we deal with securities that are not accepted by the private market? We apply 100% haircut on the private market to construct the haircut gap. So if the security is non-eligible, we also exclude them. The results don't change in terms of net messaging. And the final thing on the French and Italian, we ran the robustness test that when we drop one country at a time and the results are not affected, we can drop Italy and France together and see what's going to happen. My sense is it should be fine. One last thing I want to say on Italy, my sense is the biggest issue with Italy around the LTRO is that Italian legislation allowed banks to pledge their own retained bonds. So we do a lot of work in constructing the bank ownership structure, and we exclude the pledging of your own bonds, so of the bonds that belong to the same banking group, to really elaborate more on this effect of the actual interconnectedness and not just the interconnectedness within the banking group.
All right, thank you, Martina. We'll run a little bit short of time. So Hedvig has posted a link to a breakout session. So I encourage everyone, panelists or attendees, to be part of the breakout room, and we can continue discussions there. And we start the next session at 5:20. So that will be in 15 minutes. So see you then. All right, it's time to start. I see that most have returned from breakout rooms, so let's have this final session with 2 papers. And the first paper is liquidity restrictions, runs, and central bank interventions, evidence from money market funds. And the presenter is Yi Li.
Thanks, Magnus. And thanks a lot for the conference organizers for including our paper. Can you hear me fine? Great. So let me first share my screen. Okay, so the title of the paper is Liquidity Restriction, Runs and Central Bank Intervention, Evidence from Money Market Funds. It's a collaborated work with my colleagues, Leili, Marco Machiavelli, who is also in the session, and Alex Zhou. So since we all work for the Federal Reserve Board, the standard disclaimer applies here. The views expressed here are those of the authors and do not necessarily reflect those of the Federal Reserve Board or its staff. Okay, we know that prime money market funds in US are important short-term funding providers for both financial and non-financial firms. And before the COVID-19 crisis, in total, they manage about $1 trillion of assets. And another feature about prime money market funds is especially those funded by institutional investors are that they are very vulnerable to acute investor runs during crisis, as we've seen in both the 2008 and 2020 crisis. So after the 2008 financial crisis revealed the fragility of prime money market funds, the SEC, that is the regulatory institution for mutual funds, they introduced several series of reforms aiming to make money market funds more liquid and less prone to runs. And the ultimate goals of these reforms make money market funds capable to withstand stress without the need for the Federal Reserve to step in with emergency interventions. In particular, one of the reform that is implemented in 2016 introduced the concept of redemption gates and liquidity fees. So what does that mean? That means prime money market funds can impose gates and fees on their investors once their weekly liquid assets, or WLA, fall below 30%. So the intuition is the following. So when prime money market funds, their liquid asset level falls below a certain threshold, then they now have the option to tell their investors that, sorry, you cannot get your money back over the next 10 days. Or if you do want to get your money back, you need to pay up to 2% of fees, that is called liquidity fees, in order to get your money back immediately. So this introduction of gates and fees was intended to mitigate the run risk and the potential impact for investors in markets, because it essentially gives funds the option to stop the run like immediately. However, the introduction of this gates and fees was controversial to begin with. So one of the SEC commissioners said that allowing funds to impose gates and fees could actually increase an investor's incentive to redeem. And the logic goes as follows. As the chance that a gate will be imposed increase, investors will have strong incentive to rush to redeem ahead of others to avoid the uncertainty of losing access to their capital. And there also raised tons of concerns from the academics. Many people read papers about the potential unintended consequences of introducing gates and fees to money market funds. As a result, the regulation on gates and fees was passed with a very small margin by the SEC, with 2 out of 5 commissioners actually voted against it. And what is why gates and fees could introduce unintended consequence in terms of triggering preemptive runs by investors. Intuition is that there is strategic complementarities that can be induced by fear of gates and fees. That is the expectation that other investors will withdraw money and drive WLA below the 30% threshold may incentive investors to run preemptively. And this logic is consistent with the global game literature on bank runs. And another feature about institutional investors of prime money market funds also add to these effects, as they are extremely concerned about how quickly they can monetize their investments. So basically, if you tell them like your investment will be suspended, or you have to pay up to 2% of liquidity fees to redeem your shares, is considered impermissible to these institutional investors. So in this paper, we try to address the debate, or try to shed some light on the debate about gates and fees. And we address this question against the background of the COVID-19 crisis. During the 2 weeks in March 2020, institutional prime money market funds lost about 30% of their assets to redemptions. And we try to use this period and answer the question whether the WLA contingent gates and fees introduced in the money market fund reforms have exacerbated the run. In addition, we also studied the question, how did the Federal Reserve intervention stop the run on money market funds with the MMF facility? Okay, here is a brief overview of our key findings. First, in addressing the question whether the fear of WLA contingent gates and fees drive money market fund outflows during the COVID-19 crisis, we show that the sensitivity of outflows to funds WLA intensifies substantially in crisis times. More importantly, outflows accelerate as funds WLAs approach the 30% regulatory threshold. And we rule out a bunch of alternative explanations, which I will present in more details in a few slides. And then we study the effects of the Federal Reserve intervention, namely the Money Market Fund Liquidity Facility, MMLF. We start by studying who benefits more from the MMLF and how. And we also identify the role of MMLF in stopping the money market fund run. So our findings about relationships between redemptions and WLA are consistent with the views of the market participants. For example, the president of Print Data, that is a major money market fund research institution, they said that the 30% threshold has become the most important metric tracked by institutional prime investors. And in a report to their investors by BlackRock, they said that the WLA ratio is an amber flashing light for investors. The fear of the imposition of a liquidity fee or redemption gate essentially converted the 30% WLA threshold to a new break the buck triggering event for investors. And finally, Fitch Ratings also says that investors' attention is all about funds WLAs. So next, I will present our sample and data used in our study. So the crisis period in our study is defined as the 2-week period from March 9th to March 20th, 2020. And we use 4 weeks before the crisis and define that as our pre-crisis period. And we also have a post-MMF period that is 2 weeks after the crisis. And for data source, we have iMoneyNet, which provides high-frequency money market fund information, including both daily and weekly fund characteristics. And we also have SEC form and MFP that provides security level holding information for money market funds. But this information is provided at the end of each month. Finally, we have the confidential macro data from the Federal Reserve on MMLF usage. And this provides details on participants and securities pledged at the MMF. Okay, so in the first part of the paper, we focus on the theme of gates, fees, and money market fund runs, and analyze the following question. Does the fear of gates and fees drive money market fund redemptions during crisis? Could outflows be driven by investors' concerns for asset illiquidity, since WLA is also a liquidity measure, and asset illiquidity has been shown to drive redemptions of fixed income mutual funds? And also, are there any other alternative explanations? Okay, we start with the most fundamental question, that is, does the sensitivity of fund flows to WLA intensify during the crisis? And the sample period is from February 6th to March 20th, and we only focus on institutional prime money market funds. And we apply a difference in differences approach here and regress fund flow on crisis dummy, WLA level, and the interaction term of the two. So WLA is defined as is used as the most recent reading available to investors. And crisis is a dummy equal to 1 for the 2-week price crisis period. We control for lagged fund characteristics, and later we also control for some fixed effects. Okay, so this table shows the relationship between fund WLA and crisis outflows. It shows that relative to normal time, a 1 standard deviation decrease in WLA during the crisis time leads to a 1 percentage point increase in daily outflows during the crisis. And this result is robust to controlling for lagged fund flow, which is shown in the second column, and also day fixed effects, which is shown in the third column. And also we check for parallel trends, and there is no pre-trend driving our results, which is shown in column 4. Next, we study if there's any acceleration effects of crisis outflows when WLA is closer to the 30% threshold. And before we jump to the regression, we first show a chart that speak to these effects. In particular, we split fund day sample into 3 segments based on the lagged WLA level, which is WLA lower than 40, between 40 and 50, and greater than 50. And we show that the red line, which is shows WLA lower than or equal to 40, indeed, the outflow was more acute for this group of funds. So here we apply a similar difference in indifference approach, but by fund groups. And here WLA lower than 40 equals WLA if the fund's WLA is below or equal to 40% and 0 otherwise. Our regression results show that for funds shows that indeed the sensitivity of crisis time outflow to WLA indeed increase with the decline with the deterioration of WLA. For funds with WLA below 40%, a 1 standard deviation decrease in WLA leads to a 2 percentage point increase in daily outflows during the crisis. And this number is 33% higher than the crisis outflow of funds with WLA greater than 50%. Okay, so a key concern that we need to address in the paper is that WLA, by definition, it is weakly liquid assets. That means assets that mature within 1 week or can be converted to cash within 1 week. It is, by definition, a liquidity measure for fund assets. So could the intensified flow WLA relationship be driven by investors' concerns for fund illiquidity rather than the fear of gates and fees? To address this concern, we use an alternative liquidity measure, namely DLA, And DLA is daily liquid assets. That's the share of a money market fund's assets that could be converted to cash overnight. And it is an important indicator of the fund's liquidity condition. In fact, the SEC requires money market funds to maintain their DLA above 10% and disclose it at the same frequency as WLA on their websites. The key difference between DLA and WLA is that the option to impose gates and fees is only contingent on WLA, but not coupled with DLA. So if our results are indeed driven by asset illiquidity, we should find similar flow sensitivity to DLA. However, in our regression results, we show that DLA does not have any significant impact on outflows during the crisis, as represented by the insignificant coefficient on the interaction term of crisis and DLA. Moreover, when we control for DLA effect, even after we control for the DLA effects, we still find that the effects of WLA on crisis time flows remain very strong. And another way to address this concern is to study the 2008 money market fund run, when money market fund investors were not subject to WLA contingent gates and fees. And these runs share some similar features. They both last about 2 weeks before the Fed's intervention, and they both had an outflow of 30% of their assets under management for institutional prime money market funds. Here we show the results for 2008 regression. And it shows that the coefficient on crisis WLA interaction term is substantially smaller than that in the 2020 results. More importantly, we don't see any stronger sensitivity to WLA for funds with lower WLA in 2008 results, as shown in column 3 and column 4. Okay, so another concern for our finding is this possible driven by reverse causality? That is, what if it is not WLA level driving fund flows, but some factors driving both, or is flow driving WLA and flow is very persistent over time? To address this concern, we use an instrument variable for WLA, namely we call it maturing. It is the predetermined amount of a fund's term assets that are going to mature on a given day during the crisis. So intuitively, if an asset is going to mature during crisis, it naturally will convert to cash, and funds with that cash will convert that into WLA. So it will lead to a mechanical increase in WLA, but it doesn't necessarily drive fund outflows because it is predetermined amount of a fund's term assets maturity. And we use this instrumented WLA, and it continues to explain crisis time flows. Okay, another potential driver is namely floating net asset value. That is, in 2006 money market fund reform, in addition to the introduction of gates and fees, there's another key change to the money market fund industry. That is, institutional money market funds are required to adopt floating knife, and this could expose investors to more uncertainty. However, in our regression results show that fund knife during the crisis do not drive flows. And the possible explanation here is that the lowest knife during the crisis is 0.998, far above the traditional sense of breaking the buck, which is 0.995. And while the lowest WA is 27%, that is already breaching the 30% threshold. So the situation for WLA is way more severe than the conditions for floating knife.
Yi, I just wanted to be aware that we have about 2 more minutes for you.
Thanks. We'll try to wrap up in 2 minutes. So we also address a bunch of other alternative explanations to show the robustness of our results. And next, in the second part of the paper, we try to show the stabilizing effects of the Federal Reserve intervention, namely the MMLF. And we first show who use more of the MMLF facility and what assets do they pledge using the macro level MMLF data. And we also identify the effects of MMLF in stemming money market fund outflows by addressing the key challenge here, that is with other policy actions around the same time. How do you know it is MMLF specific effects, but not other policy effects that come the general market? Okay, so in our study on what drives the usage of MMF facility, we show that first, this facility had a heavy usage, about 56 billion in 2 weeks of usage after the introduction of this, after the implementation of this facility. And we use macro level MMF data and money market fund security level holding data to show that funds with larger crisis time decline in their WLAs use more of the MMF. And it is interesting to see that in column 3, we have both crisis fund flow and crisis decline in change in WLA, and this crisis time change in WLA actually dominates the effects of crisis time outflow in driving the usage of MMF. And we also found that funds prioritize to pledge longer maturity securities at the MMF.
So it's time to wrap up, Yi.
Will do. And next, for the effects of MMF in stemming money market fund outflows, here we just try to find a control group who experience similar outflows as US prime money market funds, but not eligible to MMF. And we found that by using this control group, we show that the US money market fund had a much quicker and larger rebound in their flows following MMF relative to the MMF ineligible offshore US dollar funds. Okay, so the conclusion of the paper is, first, we show that the fear of WLA contingent gains and fees exacerbates investor runs on money market fund during the COVID-19 crisis. And then we identify the role of the MMF in stopping the money market fund run. Thanks a lot, and I look forward to the discussion.
All right, thank you, Yi. And the discussant is Guillaume Vuillemey.
Okay, so thanks a lot for having me. Let me first share my screen. Okay, now it should work. Okay, so it's okay, very good. So let me start with a brief summary of the paper. So the basic starting point of the paper is something that has been discussed quite a lot over the past few years. I think starting quite a lot actually with the paper by Chen, Goldstein, and Jiang, which is essentially the fact that money market funds exhibit strategic complementarities in redemption decisions. The basic idea is that, okay, if you are an investor and you withdraw today at the current net asset value, then presumably the fund will use some of the cash to redeem, and in the next few days we'll need to rebuild the cash balance, and therefore we need to sell assets, and those asset sales will push down the prices, leading to a lower net asset value for the residual investors. And so perhaps those guys would have been better off selling preemptively. And so a number of reforms, including redemption gates and liquidity fees, have tried to mitigate this problem. And in the specific case of the reform studied in this paper, it's if some measure called weekly liquid assets falls below 30%. But the paper makes a very nice point, I think, which is that, well, it's not obvious that penalizing investors who withdraw will solve the problem, simply because the anticipation of those penalties may actually amplify the preemptive redemptions. Okay, and so ultimately, I would say it's kind of an empirical question. Theoretically, we know it can happen, but does that happen? And so the paper shows that yes, it does happen. And to be honest, the paper is very nice, very well executed, also very intuitive. So it's hard to come up with a big point to make for me in the discussion. Of course, the key issue empirically is an identification issue, which is that if you work around this threshold of 30% of weekly liquid assets, you may think, well, perhaps this threshold actually correlates with the overall liquidity of the fund. And so that may be, a different variable that is driving the result. But actually, the paper does a very nice job at ruling out this story. So again, I'm not going to take the discussion from there. Okay. And the paper also shows that only ex post some policy intervention could help. So what I'm going to do is actually something only very minor, trying to just push the paper a little further on the theory side and on the interpretation of those strategic complementarities. Okay. So the first thing is actually, when I was reading the paper, I thought about something which is not so much a comment about this specific paper, but a comment about this whole literature, starting with the paper by Chen, Goldstein, and Jiang. The basic idea is, as I said, is the idea that if someone withdraws today, in some sense, he will impose a lower net asset value to people going forward because the fund will need to sell some assets going forward. And that's what triggers strategic complementarities. That's the argument in Chen, Goldstein, and Jiang, and that's the argument in many papers in the literature. But actually, when you think about it, it's not so obvious that the story is like that. Because in a sense, of course, if there are asset sales tomorrow or in 2 days, perhaps there will be some price pressure and perhaps the price will go down. But, if it's pure price pressure, then there should be a reversal. Okay? And if there is a reversal, then it's not so clear that many investors care about that. Okay? Because if the price, maybe they go down, but if they revert in a few more days, if the horizons of investors is slightly longer than those few days, then they should not really care. Okay? Unless they are very short-termist. Okay? By the way, I don't know if people have looked at that in the literature, whether those people that seem to respond to strategic complementarities are more short-termist than others. But I think it would be important to do that, not for this specific, but for the literature in general, because I think that's the only way the story could go through. Okay? And instead, if there is no reversal in the prices when the money market funds sell, then it means that the initial sales, or at least initial redemption decisions contain some information about returns, and in which case it may be fully rational for people to also withdraw, even if there is no strategic complementarity. Okay, so I'm not sure what you can do with this comment, maybe nothing, but I think at least for people in this field, I think it's an interesting thing to keep in mind, and perhaps there are more things to do around this side. And the second broad comment I have is the following. So in a sense, clearly the paper is an empirical paper, and I don't want you to write any model or anything like that. But still, when you think about it, there are several models of strategic complementarities in the literature. And these models are quite different from each other. Okay, so if I take probably the two most important models in banking, we have Diamond and Dybvig, where it's a model where runs are completely uninformed. They are purely random. There is one efficient equilibrium and one inefficient equilibrium. It's a pure coordination problem. And there is the more sophisticated version by Goldstein and Pausner, which is a model of global games, which has the nice feature that it helps selecting a unique equilibrium. And the trick in this global games literature is that investors, so in his model, depositors, but in your context, money market investors, get a noisy signal about returns, and they use this signal to coordinate. So runs or withdrawals still correlate with fundamental information, but there is still inefficient strategic complementarity. And so I think at the moment in the paper, you kind of pull those two models together and you say, look, there are models of strategic complementarities, Diamond and Dybvig, Goldstein and Pausner, and we find empirical evidence for those strategic complementarities. But maybe one way to go a bit deeper is to think, well, which of those two models actually best fits the data? Is there a way to think that either one or the other best fits the data? And of course, the interest is not just purely theoretical, it's also in terms of policies, because presumably the policies you want to impose at the Fed or at the SEC or wherever are quite different across those models. Okay. The nice thing, I think what you can somehow do that. So in Diamond and Dybvig, we know that there are many policies or many changes in the design of the contracts that can rule out completely the inefficient equilibrium. And in particular, one of them, which has been studied quite a lot, for example, by Gorton and others, is in the context of banking, what is called a suspension of convertibility. And in the Diamond and Dybvig model, that's essentially saying, okay, if there are too many people withdrawing early on, I suspend the convertibility, and other people will have to wait until date 2 in the model to withdraw. And the nice thing is that it's actually very much akin to redemption gates. Okay, that's actually a very similar idea. And so presumably, if the Diamond and Dybvig model was the one explaining the data, redemption gates would work actually very well. And you show that they don't. So this makes me think that probably the setup is closer to Goldstein and Pausner. Also because I haven't thought this through completely, but I think that if we take the Goldstein and Pausner model, we cannot have a rule as simple as suspension of convertibility or redemption gate to fully rule out everything. That needs to be checked, to be honest. So I think perhaps when we need to think a bit more what specific features of the Goldstein and Pausner model of strategic complementarities work in your context or not. Okay. And as I said, this matters a lot for policy intervention. In a sense, your paper has a kind of a bright side of policy. Okay, essentially, you say, well, these reforms did not work, but luckily the Fed came in with this program and they stopped the problem. Of course, that's not completely satisfactory, at least theoretically, because very often in banking, we know that when we have ex post intervention, it's because there was too much of something ex ante, too much maturity transformation, too much liquidity mismatch, too much leverage, and so on. And perhaps ex post, it was the best thing to do, but ex ante, perhaps some other policies could have been put in place. Okay, so there are papers by Diamond and Rajan, Fari and Tirol, and so on, making this type of point in the context of banking. And so one question I ask, and I may not know all of the papers in this field, but I think it's very interesting. If you think that the type of strategic complementarity that you have here is closest to what Goldstein and Pausner have in mind, which kind of policies could have worked ex ante? So what other rules could have the SEC or the Fed imposed on the contract design ex ante to potentially work? I don't know whether there is any such policy or whether we are left with ex post interventions as a second best. I don't know the answer, but I think that could be nice to think about that. And so with this, let me conclude. So I think it's a very, very nice paper. I totally buy the empirical findings. That's why I did not spend any time discussing them. And well, if anything, I would like to have a bit more theoretical structure to know what models of strategic complementarities best explains the data, and what policies could be based could be designed based on these theoretical insights. Thanks a lot.
Thank you very much. I encourage questions, comments, suggestions from participants. Yi, would you like to respond briefly first?
Yeah, just one sentence. Thanks a lot, Guillaume, for the careful discussion. It makes a lot of sense for us to think even deeper about the theoretical foundations of the strategic complementarities that we documented in the paper. And your discussion is very helpful, we spent some time try to find the existing theory that ties best with our paper. And we think it is important to know the exact source of strategic complementarities. And also that is linked to how the discussion right now in DC, that is how to, in the post-COVID era, how to address the potential fragility of money market funds with new series of policy reforms. So that is all very relevant. Thanks.
We have a question from Quentin.
Yes, thanks a lot, Yi. So I was wondering if your results are saying something about potentially the interaction between floating NAV and redemption gates. Because I guess the way I see it, these two policies don't have to be combined, and maybe it's the combination of the two of them together that made it. Or rather, actually, the way I would see it is that maybe if you have floating NAV, then redemption gates are not necessary. I'm just wondering how you are thinking about these two policies.
Yeah, thanks. It's possible that there are some reinforcing effects between floating NAV and WLA, especially when funds suffer large outflows. It's possible driving down both WLA as well as the NAV level of the fund. So far, we controlled for funds NAV during crisis time and see that's not affecting the effects of WLA's driving force, but it is something that we can consider the reinforcing effects of the two.
Thank you.
Anyone else? Any questions, comments?
Sorry, if there is a minute, I wanted to address Guillaume's point.
Please go ahead.
So Guillaume, thank you for the discussion. I agree that the only problem with ex-post interventions is moral hazard. However, and we should have done it a little bit more, because I agree with you that, showing that ex-post interventions work is kind of like a little bit of cheating, because you don't take into account ex ante how much more risk you took. The thing is, if you assume that money funds were expecting interventions, you would have seen money funds in the midst of the run loading up on illiquid assets, long-term illiquid assets. That's exactly the opposite of what happened. And we were talking to these funds on a daily basis. These funds were only reinvesting in overnight commercial paper. They were so frightened of not having liquidity that they were not even thinking that, let's game the Fed, let's invest in long-term assets so that when the Fed intervenes, we make a nice return. So that's all I wanted to say. But I agree with you that there's always the ex ante moral hazard that needs to be considered.
All right, let's move on to the final paper in the conference, Safe Assets and Financial Fragility Theory and Evidence. And Tony will start.
Excellent, thank you. So first of all, thank you very much to the organizers for including this paper. It's joint work with Marco Machiavelli, who has just spoken, and we're going to divide the presentation in the first part on motivation and theory, which I will present, and then Marco will present the second part, which focuses on the empirics. And this paper is very closely related to the previous paper, thinking about money market mutual funds and fragility. And I had not planned on getting into some of the modeling details on strategic complementarity, but given the previous discussion, I might expand a bit on this as well. So the motivation of the paper is that money market mutual funds, which we call money funds for short, issue shares that are redeemable on demand, and they invest in short-term debt instruments. And while government money funds invest in liquid government debt and repos backed by such debt, there are also prime funds that can additionally invest in more illiquid and relatively riskier assets such as commercial paper and certificate of deposits. As a result, as previous speakers have argued, prime money funds can be subject to runs, and indeed we've seen that both in the 2008 and 2020 crises. The question we are trying to address in this paper is to study whether financial stability could be improved by providing safe assets to these prime money funds. And in principle, providing such safe assets, providing access to safe assets could affect financial stability along a couple of dimensions. So at the level of the money fund, it could reduce the run risk of money funds by giving them kind of a safe or liquid buffer. And then whenever these funds face redemptions, they can accommodate these redemptions without having to liquidate assets at a cost. As I mentioned before, these funds, these money funds lend to the real economy, for example, via commercial paper or certificate of deposits. So to the extent that the stability of the money funds is improved, this will also mean that the lending to the real economy, to private borrowers, is stabilized. So we would expect to see an improvement in financial stability also in this separate market in kind of the lending to the real economy. So the objective of this paper is to study these issues both theoretically and empirically. So in the first part, we are proposing a parsimonious global games model of mutual fund runs. So in particular, we look at how access to a safe asset affects the strategic complementarity in redemption decisions. And we show theoretically that it reduces run risk. And as a result of the lower run risk of money funds with access to safe assets, as well as the features of safe assets themselves, we show that funds that have access to safe assets can lend more to private borrowers, fund more of these illiquid assets, and get more lending to the real economy, even in crisis times. And in the second step, we take the model's implications to the data by looking at an empirical laboratory in kind of around end of 2013, So we use both the US debt crisis episode at that time and the rollout of the overnight reverse repo facility of the Federal Reserve. And I should say that these are just Marco and my views and not the views of any of the institutions we are affiliated with, which I forgot to mention on the first slide. And we argue that we have a quasi-random assignment of money funds into treated and control groups. The treated group will be money funds that have access to this overnight reverse repo facility, which in that period is the safe asset, while control funds do not have access. And I'm sure that Marco will expand on that later. And the second aspect is that at the end of 2013, we had the US debt limit episode. So while treasuries are usually considered safe assets, around the debt crisis episodes, they're actually not. The safest assets in those periods are the overnight reverse repo as offered by the Federal Reserve. So in using that empirical laboratory, we find evidence consistent with the two implications of the model, whereby access to safe assets first reduces the run risk of money funds, and second leads to more lending to the real economy. So let me give you a sense. I'm not going to show any equations, it's all in the paper, but let me give you a sense of the model that we set up and some of the key economic insights. So it's a global games model of investor redemptions, and it builds on the Chen, Goldstein, Chang paper that was mentioned previously. So investors receive a noisy private signal about fund performance, and based on that signal, they decide whether or not to withdraw funding, i.e. redeem their shares from the money fund. The contribution of the model is to look at heterogeneous assets. So we look at money funds that hold a portfolio of risky and safe assets. So the risky or the relatively risky assets is the lending to corporate borrowers, the commercial paper and certificates of deposits, for example, while the safe assets are ONRP and treasuries. And consistent with the idea of being in the debt crisis episode, a treated group which has access to the ONRP can liquidate at zero cost. The idea is just the overnight reverse repo matures and you don't reinvest, so you can use those funds to meet any redemptions. By contrast, in that period, if you held treasuries, you can sell them, but there's a small cost. So there's a positive liquidation cost for treasuries for those funds that have used treasuries to meet redemptions. And once we allow for both risky and safe assets, we can get two results in terms of strategic complementarity. So we can get kind of the standard results that people have emphasized in the literature, whereby redemptions of some investors imposes costs on non-redeeming investors. This arises from either transaction costs that the fund has to incur or market illiquidity. And the idea, as Guillaume in his discussion also mentioned, is that these costs are not fully borne by redeeming investors and then imposes a negative externality on non-redeeming investors. And as a result, there can be strategic complementarity in redemption decisions. My incentive to redeem increases in the proportion of all of the other investors redeeming from the money fund. Two notes. First, we're looking at the end of 2013. That's well before the 2016 money fund reform. And second, this behavior occurs in our model when some risky assets are liquidated. However, when no risky assets are liquidated, so when there are fairly few redemptions, you can actually get the opposite result. So the existence of safe assets can lead to strategic substitutability. So if few investors redeem, I actually have an incentive not to redeem. Why? These redemptions can be met with cash, so that doesn't impose any costs on me. Plus, and in some contrast to kind of banking applications where I have a debt claim, with money funds and mutual funds in generally, I have an equity-like claim, so I get an equal share of the final proceeds. So if some people withdraw, that means there are fewer people who have to share the pie to more. So actually, I would like not to redeem and wait in order to get my share of the pie. And overall, we have to consider that there's both strategic complementarity and substitutability, which makes the problem challenging. We can, however, employ the methods proposed by the seminal paper by Goldstein and Pausner in the Journal of Finance that gives us the toolkit to deal with what's called one-sided strategic complementarity. We do so in the paper and solve for a unique equilibrium, and we can use this unique equilibrium to derive testable implications. So the first one is that money funds with access to a safe asset, so access to the overnight reverse repo facility, are less fragile. So treated funds experience smaller outflows in response to at-risk exposures because they have lower costs of liquidation, and intuitively the degree of strategic complementarity is mitigated by having access to a safe asset. Second, money funds that have access to a safe asset liquidate less than expectation, so they're able to lend more to the real economy in expectation. We won't discuss it much in the presentation today, but in the paper we also have a third result, we also test, that relates investor sophistication to money fund fragility, and we document evidence consistent with that third result as well. Having established these two testable implications, let me hand over to Marco, who tells you about the empirics and the tests.
Thank you. So I'll share my screen now. So let me know if you can see it.
I see the screen. Maybe you want to make full screen?
Yeah, working on it. Okay, great. So let me turn to the empirical analysis. So again, what is the safe asset here? It's the Federal Reserve overnight reverse repo. This was introduced to control short-term rates in 2013 because at some point, as it happened in 2015, the Federal Reserve wanted to tighten monetary policy. So to have a floor under overnight rates, they decided to provide an outside option as the overnight reverse repo. So here with the ONRRP, counterparties can invest cash at the Federal Reserve, obtain treasury collateral, and earn the administered rate. So by virtue of the fact that both collateral and counterparty here are the safest possible, we call that safe asset. Now, the problem is that there is always selection of who is the counterparty to the Fed and who is not. So we cannot just say, let's look at the counterparties to the Fed and compare their behavior to the non-counterparties, because clearly these are different. So in order to tease out the effect of the ONRRP, we need to look at the early stages of the rollout of the facility. And this is what I mean by that. So in 2010, the Fed started some sporadic test operations. In 2010 September, they introduced money funds. So originally they were only primary dealers. In September 2010, they introduced money funds. And the initial eligibility criterion that was the most stringent was that money funds needed to have assets under management above 10 billion. This requirement is brought down to 5 billion in September 2011. And then we have in September 2012, the last application deadline. So if you applied by September, good. Otherwise, you would have to wait for 2 years. The interesting part is that in this 2 years window, we have the introduction of the Federal Reserve ONRP facility in September, and few days later, we have the US debt limit. So in this window of 2 years, we have technically eligible money funds that are not, however, treated with the ONRP just because they satisfy the eligibility criteria in 2013, but they did not so in 2012. So they are technically eligible, but they cannot apply. And therefore, here, just in these 2 years, we have an interesting control group of funds that are technically eligible, but they are not treated. And so we'll look at funds in the treatment and control group with assets under management in the neighborhood of 5 billion, which is the threshold for eligibility. And that will give us, a treatment and control. All right, so what is the shock here? The shock is the 2013 US debt limit. Long story short, in the US, there is a limit on the amount of outstanding treasuries. And once the debt limit is reached, the Treasury Department has some extraordinary measures to continue to fund the government. When these measures run out, unless the government raises the debt limit or suspends it again, the Treasury may have to default on some Treasury bills or some coupons. And this is pretty much what people were afraid of in 2013. The Treasury tells the public that they will run out of extraordinary measures by October 17. And shortly after this communication, there is a government shutdown on October 1st. The market doubts that the federal government will resolve the debt limit in a timely manner, and we see spikes in bill yields. The spikes are concentrated in bills that mature shortly after the October 2017 deadline. And one day before this October 17 deadline, the government finds an agreement, they suspend the debt limit. So from all of this, you can see that treasuries with payments between October 17 and November 22nd here were at risk of delayed payments. The market did not expect an outright default, but just a delay in payment. That's enough to unnerve money markets. So we'll use these securities as at-risk securities, and we'll trace these securities in the holdings of the money funds, and we'll look at the share of money fund holdings in these at-risk treasuries as the shock that we care about in the paper. So we use weekly flows and yields from iMoneyNet. We can trace the exposures to the debt limit crisis by using NMFP month-end reports, and we also get treasury payment dates from the monthly statement of public debt. The first question we want to test, again in line with the model, is whether the overnight reverse repo or the safe asset reduces the sensitivity of outflows to risky treasuries. So we do that in a diff in diff setting where we look at the sensitivity of outflows to at-risk exposures. We allow the effect to be different for treated funds. We allow the effect to be different during the crisis, and the diff in diff term here will be whether the treated funds are less sensitive during the crisis specifically. And again, treatment and control. Treatment funds are ONRP counterparts with assets between 5 and 8 billion. In the control, we have funds of the same size, but that did not satisfy eligibility criteria back in 2012, so they are not ONRP counterparties. And what we find is indeed that during the crisis, having more at-risk exposures leads to more outflows, so a negative coefficient, but the effect is completely neutralized by having access to the facility, to the safe asset. So that's in line with the model. Having a safe asset reduces the sensitivity of outflows to risky exposures. And then the second question is this additional sensitivity stabilizing also the access to funding of the riskier lenders, or is it the case that this extra stability comes at the expense of a flight to liquidity in a way? And so this is the hypothesis we test. Here we define prime risk as the risky lending. So it's the share invested in second-tier commercial paper, foreign certificates of deposit, and asset-backed commercial paper that the literature has identified as the riskier portion of prime funds assets. We do a similar exercise as before, and we see that during the crisis, having more at-risk treasuries leads to a reduction in prime risk, so a reduction in lending to riskier borrowers by the control group, but the effect is neutralized fully by having access to safe assets. So in a way, safe assets reduce the risk of this double run. It reduces the risk of a run on money funds, and by virtue of that, money funds can also provide more stable funding to the riskier borrowers. So that's fully in line with the model. Then finally, we have a battery of robustness tests where we show that our results are not driven by managerial skills. We do that by comparing the 2011 debt limit to the 2013 debt limit, and we show that it's not the case that if you avoided more at-risk securities in 2011, you avoid more at-risk securities in 2013. So there seems to be no correlation there, no learning or no skill involved there. We also, by comparing 2011 sensitivities to 2013 sensitivities, we can rule out the possibility that the treated group is indeed less risk sensitive than the control group. It's actually, if any, the opposite. And we also have this interesting episode that, again, in 2011, we have money funds that are counterparties to the test operations, but they do not have access to the standing facility. And we show that our results are not due to an imprimatur effect, meaning a stamp of approval of the Fed counterparties being more stable, and not due to the actual access to the ONRRP. So we show that, again, it's not due to an imprimatur effect, but it's actually due to the actual access to the facility. And finally, we show that the effects are not driven by pre-existing trends in a definitive style sense. So,
Marco, it would be great to wrap up.
Perfect. So let me conclude. The provision of safe assets by the Federal Reserve delivers two main financial stability benefits. It lowers the sensitivity of outflows to risky exposures for the treated funds. And by virtue of that, it allows these treated funds to keep funding less liquid assets or ex-ante riskier borrowers. So overall, the concern that the provision of safe assets leads to disintermediation in times of stress, which is a point that was raised even in the FOMC, this seems not to be the case. So we find positives in providing safe assets to shadow banks, if you want. So with that, I conclude. Thank you.
Thank you. And the discussant is David Andolfato.
Oh, very good. Okay, thank you very much for giving me the opportunity to participate here and kind of give me the chance to go through and read this paper. I thought it was really a very nice paper. The paper is centered on the Fed's relatively new deposit facility, the overnight reverse repo facility, and something that was implemented, as I'm sure Marco described. I came a little late, I apologize, in 2013 to aid with the Fed's kind of preparations for liftoff, raising the policy rate off the effective lower bound. But at the time, there was a considerable discussion. There was concern about what the financial stability ramifications of such a facility might pose. So, for example, to quote from a New York Fed working paper in 2015, it says that in principle, there are two distinct channels through which the establishment of an overnight reverse repo facility could affect financial stability. First, the availability of an elastically supplied risk-free asset could influence the likelihood that money market investors would shift rapidly from providing short-term funding to holding only very safe assets. That is, the facility could affect the chance of a widespread run. And furthermore, it might exacerbate it. And it concludes by saying that the academic literature does not provide strong guidance regarding the effects of a new risk-free asset on the likelihood of sudden shifts towards safe assets. Well, here I think this is exactly where this paper makes a very nice contribution. It provides an answer to this concluding statement here by the New York Fed. So the paper is essentially, the way I read it, an empirical investigation. The authors take a set of commercial paper money funds that issue demand deposit liabilities to finance risky loans. So they're essentially uninsured banks. And prior to the availability of the facility, this facility, the closest thing to kind of a safe asset for these funds were T-bills, which normally we think of as being pretty safe, but evidently not as safe as what many of us think in all contingencies. Because what the overnight reverse repo facility did was to provide a select number of funds, commercial paper funds, with an even a safer asset. Now, and some of these funds made the application deadline in 2012 to have access to this facility in time for 2013, and some funds that were technically eligible. I mean, they were kind of, arguably kind of the same sort of properties as the other funds, but they missed, for some reason, they missed the deadline, and so we're not eligible for using the facility in 2013. And kind of why this is interesting is because 2013 we had that ceiling fiasco that kind of manifested itself as kind of pretty sizable discounts on even T-bills at the time, and I was very surprised to see that data. It was very interesting. Evidence that these very, very short-term T-bills are not quite as safe as what one might be led to believe, at least not in all circumstances. And of course, what the authors demonstrate is that the funds that had access to the facility during this debt ceiling episode performed relatively well. They were relatively more stable. They experienced fewer redemptions. They were better able to maintain private lending than those funds that did not have access. So I think this is a really, really interesting result. Now, by way of comment, I mean, I guess, just to think about something to comment on, I mean, one could think about kind of the robustness of this finding. What the findings show is that introducing a safe asset can be stabilizing. And this is, furthermore, consistent with a class of theories, in particular, the class of theories highlighted by the authors themselves, Chen et al., who use these global game approaches to banking and its financial stability. But I think we should keep in mind that the results do not necessarily imply that introducing a safe asset cannot be destabilizing, or that it be destabilizing in all circumstances. And certainly this is the case in suggested by some theories. So for example, John Bryant has a very nice paper, 2005, demonstrating this, where in the environment he lays out, which is not completely unreasonable, the supplying a safe asset potentially opens the door to run equilibrium in that model, and kind of removing the safe asset actually can coordinate private sector equilibrium on the no-run equilibrium. So kind of, if you don't have anywhere to run, you're not going to be prone to kind of this coordination failure that takes you to kind of a self-fulfilling run. So I mean, is that something to be taken seriously? I mean, theoretically, we know how it can work. I mean, whether it's empirically relevant is another question. It might be in other circumstances, and we can't just take the results that were shown here to kind of, well, there we have it. I guess we've answered the question. It might depend on particular circumstances. So that's just a little bit of a caveat. But in general, kind of like having spent a considerable amount of time kind of studying the theory and evidence, but theory in particular, and this run literature, what I've discovered, I think, is that these runnable structures have kind of less to do with the availability of a safe asset and much more to do with the way the contract is designed. And this is true, for example, in the Diamond and Dybvig model. I mean, many people view the Diamond-Dybvig model as kind of the canonical model of bank runs and banking instability. I strongly push back against that. That's actually not what the Diamond and Dybvig model is. It is in fact a paper that demonstrates the resilience and the lack of runs in a banking setting where the bank contract is actually designed optimally. Diamond and Dybvig actually do not demonstrate the existence of run equilibria under optimal contract designs. So, and there's been a whole big literature kind of trying to expand kind of what potentially is missing in that literature. Now, this is the same sort of argument kind of applies to the global games literature, the Chen et al. This class of models begins, I think, very sensibly, kind of describing kind of the properties of real world type of financial contracts. But we should keep in mind that that the contracts that are written down in this class of models are not necessarily optimal relative to the environment that they're describing. So I just find that kind of an interesting question, whether the propensity for fragility is a byproduct of kind of poor contracting or whether it's something intrinsic to the environment. I think that's just an interesting question and something we should all keep in mind here. But in terms of what I like about the paper is it has some nice policy implications. I think but we should keep in mind, of course, in line with these models that I'm familiar with, that less fragility is not a priori desirable. There could be trade-offs involved, and we should always be aware of that. We shouldn't take stability as axiomatic, I don't think. So to give an extreme and kind of silly example, I mean, financial autarky is also a run-proof equilibrium, but I mean, I don't think that we're going to promote financial autarky for some financial stability purposes alone. But if stability is of paramount concern, and I do think that it should be in many cases, then what the results here suggest is that the Fed should perhaps consider expanding access to this overnight reverse repo facility. And indeed, what I kind of find interesting here is perhaps the implication is that perhaps it should expand it all the way. For example, in terms of providing a central bank digital currency, which is, after all, just basically permitting universal access to kind of a deposit facility. And the people who are worried about the financial stability concerns about the CBDC, central bank digital currency, use the same arguments that were used or leveled at the potential destabilizing effects of the overnight reverse repo facility. The authors here demonstrate that those concerns seem to be unfounded, and possibly these results would translate over to actually the concerns that people have, I guess Kjell and Sternholz, for example, suggesting that a universally available CBDC might promote instability events. So I think this is pretty cool. So let me conclude. I love the paper. How can you not love this paper? Provides an interesting empirical finding. It provides empirical support for a popular class of models. I'm sure that the modelers of this class of models are very happy. And it provides real world policy advice as well. So I think I like the paper for all those reasons. Thank you very much.
Thank you, David. I'd like to open up for questions from the audience. Panelists, raise your hands or put something in the chat. So in the meantime, I let Marco and Tony very briefly, please, respond to David's sort of suggestions.
Maybe I can start and Marco can jump in later. So thank you, David, for a generous discussion and for your remarks. So we don't mean to rule out other theories. So we just started with, as you say, a popular class of models to kind of start thinking about this, thinking about implications, and then we were happy to see that the model's implications and the evidence are hopefully what we thought tightly linked, really bring the model and the implications very close to each other. But it's a valid point that that there are other theories out there, especially if you maybe allow for optimal design issues, which we do not attempt in this paper, that could also have very interesting implications.
On CBDC, I just want to insert an ad block. So it's at a very early stage, but I'm actually working on something about the financial stability implications of CBDC. So hopefully maybe next year I can get back to you on that. I think there's a lot of policy interest in that as well. It is indeed related to the mechanisms we describe in this paper. Thank you.
Marco, briefly, if you want to.
Sure. Thank you, David, for the discussion. I still have to wrap my head around the central bank digital currencies and how this result could apply there. So I don't have a smart remark there. So I'll just think about it. And Yi, I see a question from you.
Yeah, please go ahead, Yi.
Thanks. That's a very interesting paper, and I like it a lot. Just first, a clarification question. So the study is the empirical part is conducted on prime money market funds. Is that right?
Yes, only prime. Yes.
Yes. So if I remember it correctly, around 2012, 2013, prime money market funds they hold about on average, lower than 5% of their assets were invested in treasury bills. I'm just wondering, since among all these treasury bills, you have to identify those who with maturity within about 1 month window, which means it's likely that a vast majority of prime funds would have zero at-risk exposure back then. If they have very low treasury holding to begin with, and also you have to pin down the maturity within 1 month. That's just some summary statistics, and that will be very helpful in addressing this. And,
yeah, that is correct.
Yeah. Also, the first part of the empirical finding on fund outflows, it might be helpful to bring in government funds as well, since they are the major investors in treasury bills, and they may invest like 60% of their assets in treasury bills. And looking at their outflow pattern during crisis can be helpful in addressing the concern that prime funds has low exposure to treasury bills.
Yeah, indeed. The treasury share is low. The good thing is that we have the reading the day before the crisis. So, we don't have a lot of zeros because we don't have the data. The zeros are actually zeros. Yeah, but on average is like 2 to 3% share. So yes, we don't do that for government funds because their assets are all very safe. So we cannot see the riskier part of the portfolio. But yes, we could do the first part on the outflows. Thank you. And I see another question.
Quentin?
Yes, thank you. So I have one comment / question and one real question. So the comment is more that I'm wondering about the generality of your results, especially if we start to interpret it in the context of CBDC, because I would probably need to spend a bit more time reading the theoretical part, but you could potentially imagine, especially if you have a global game, that you have nonlinear effects. Like, so if the shock is small, then that doesn't really trigger any incentive to have a run. But then if you have a large shock, then suddenly you move into this other regime, and then in that case, everybody starts to run and goes to the overnight RRP facility. So I would just caution a little bit on that interpretation. And then I had a question, but I think it doesn't come to my mind now. So if it comes back, I'll come back to you.
Well, you have a chance to ask the questions in a breakout session. So
Exactly,
we will keep the breakout session, the breakout room, same link as before, and it's in the chat. We have repeated it now. So if you would like to continue discussing, please do. But I think it's time for us to close the conference. 3 intensive days, and I would like to thank all the presenters, all the discussants, and not the least everyone who has participated and listened to the different presentations. I really would like to express my sort of really big thanks to Adrian and Quentin, who has been the key organizers of the conference. And also in the background, some of you have had email correspondence with Hedvig, but she has done a terrific job making this possible. So I guess we can, give us an applause to everyone here and just sort of be happy. We close this, and the breakout session link is open if you would like to continue the discussion. Thanks and take care.